What's going on YouTube? My name is Chris, and in today's video, I'm going to explore the world of options trading with you, even if you don't know one thing about options trading. I will be explaining the most important options trading concepts to you using examples, lots of examples, and visualizations so that you can understand and actually see how options work in the real world. My goal is to provide you with all the information that I would put into a beginner course, but give you everything for free. So with that being said, grab your favorite beer, your favorite wine, kombucha, or whatever your thing is, and let's get started. So the first step in our options trading journey today is to first understand and learn about the basic option characteristics that all options have, and briefly discuss how options are different from shares of stock. Option characteristic number one is that all options have an expiration date. This is different from shares of stock because if you buy a share of a company's stock, there's no expiration date on that position. You can hold that share of stock forever as long as that company doesn't go private. There's nothing that's forcing you from closing that position. But with options, all option contracts have an expiration date, and the expiration date could be today or it could be 2.5 years from now, and that means that when you are trading options, you have to choose a time frame for your position. Now this will make more sense when we go through the examples in just a second, but the first thing to know is that all options have an expiration date, and after that expiration date, that option will no longer exist. Option characteristic number two is that all options have what is called a strike price. The strike price is the price in which the option can be converted into shares of stock. And exactly what that means is that if I have an option with a strike price of $105, that means that in the future, if I want to buy or sell shares of stock using my option, I can do so at the option strike price of $105. So this is really important, and it doesn't have to make sense right now, but basically an option's entire valuation or price is based on the fact that it has the ability to be converted into shares of stock at its strike price. So we'll go through a bunch of examples, so don't worry if this doesn't make sense quite yet. Option characteristic number three that we have to discuss, and the final one that we will discuss before moving forward, is what is called the option contract multiplier. So this is really confusing, and I hate it myself as someone who teaches options because it makes things pretty confusing. But if I see a share of stock that has a stock price of $120, I can buy one share of that stock with $120. But if I see an option and the option price is $5, I cannot actually buy that option with $5 US. I actually need $500 because options on stocks can be converted into 100 shares of stock. And because of that, we have to multiply the price that we see by 100 to get the option's actual value, or what is called the option premium. So let's build on these three option characteristics, and let's move forward by discussing the two option types and get into some examples and clearly look at what these three characteristics mean in regards to the examples. The first option type is called a call option. At a very high level, call option prices will increase as the stock price increases, and call option prices will decrease as the stock price decreases. So the price of call options moves with the stock price. But why do call option prices move with the stock price? Well, a call option gives the buyer the right to buy 100 shares of stock at the call option strike price between now and the expiration date of that option. Remember that one of the characteristics of all options is that they have a strike price. And for call options, the call option can be used to purchase 100 shares of stock at the call option's strike price. And as we'll see in an example in just a moment, the ability to purchase shares at the call option strike price, which never changes, will get immensely valuable if the stock price increases significantly higher than that call option strike price, because the option can then be used to purchase shares of stock at a steep discount to the current share price. So without getting into an actual option or stock market example just yet, let's explore what a call option does and how it works by using a very simple example. Let's imagine that there is a house, and the current value of this house is $200,000. Now, I am personally interested in buying this house because I think that the value of the house is going to appreciate significantly over the next 2 years. But I don't want to buy the house right this second. So I'm going to buy an option that gives me the right to buy the house at a price of $200,000 between now and 2 years from now. So we can call the strike price $200,000 since my option that I'm buying on this house gives me the right to buy the house for $200,000 or at the strike price of $200,000 between now and the expiration date in 2 years from now. So that's what I'm going to do. I'm going to buy this option that gives me the right to buy this house for $200,000 no matter what the house price does between now and 2 years from now. But I don't just get the ability to purchase this house for $200,000 between now and 2 years from now for free. I have to pay for this contract because for me, there has to be some sort of risk. There can't just be reward. If somebody were to say, you can buy this house for $200,000 between now and 2 years from now, no matter what, and you don't have to pay for that right at all. Well, that would be amazing for me because if the house price falls, I don't have to buy the house. But if the house price goes up to $300,000, then I can buy the house at $200,000, and there was never any risk for me, but there was only reward. So that's not a real scenario, and for me, there has to be some risk, and what that means is that I have to pay a premium for the right to buy this house at $200,000 between now and 2 years from now. So we would call that the option premium. Let's say that I pay $10,000 for this option. So I'm saying I want to buy this house for $200,000, which is the strike price, between now and 2 years from now, which is the expiration date. And my premium for having that ability over that time frame is $10,000. Now let's say that 1 year from now, the house is valued at $350,000. I have possession of a financial contract that gives me the right to purchase that house for $200,000. And with the house currently valued at $350,000, what do you think that means for the value of the financial contract that I have, which is called an option? Well, as you might imagine, since I can buy the house for $200,000, but the house is currently valued at $350,000, the financial contract that I have, which is called an option, is immensely valuable. So now I can actually exercise my option, meaning that I will buy the house at the strike price, which is $200,000. And since the house is currently valued at $350,000, I am buying something that is worth $350,000 for a value of $200,000. And because of that, we could say that my profit from this scenario is $150,000. So that's the golden scenario. Now, because I paid $10,000 for the option initially, my net profit in this case would not be the full $150,000. It would be $140,000. So my total profit minus what I paid for the option initially. So that is the golden scenario. But let's say the opposite happened and the house price did not increase and actually fell to $150,000 2 years from my purchase date of that option. Well, I don't actually have to buy the house for $200,000 because I had an option to buy it, but I don't have to exercise my right to buy the house at the strike price. So since the house is at $150,000, obviously I don't want to buy it at my strike price of $200,000 because if I really wanted that house, I could just buy it at the current market price of $150,000. And because of that, the option that I have is worthless. And since I paid $10,000 for that option and now it is not worth anything, I have lost my full $10,000 that I invested into that option. But if we compare this to the loss I would have had if I purchased the house initially without buying an option, I would have paid $200,000 for the house, and at the current price of $150,000, I have lost $50,000 as opposed to the $10,000 that I lost in my option premium example. So with the option, I only lost $10,000, but if I would have just bought the house initially, I would have lost $50,000. So with options, you have limited risk and immense upside potential, which is why traders love to buy options. So let's take all of these concepts that we just discussed with this basic house example, and let's look at it with a real option example in the stock market. And for this first example, we are going to be looking at a call option on Tesla, which is everybody's favorite stock right now. Unless you're short, then maybe it's not so much your favorite stock. In this real image of Tesla options, I have set up an order to purchase the Tesla call option with a strike price of $800 and an expiration in June, which is 39 days away as of this image. The strike price of this call option is $800, which means that between now and the expiration date in 39 days, if I own this contract, I have the right to purchase 100 shares of Tesla stock at the call option strike price of $800. So in our house example, it was just buying one house. So therefore, we would say the option contract multiplier in that case is 1. But in this case, since I can buy 100 shares of Tesla stock at the option's strike price, the option contract multiplier is said to be 100. And because of that, we have to look at the option's price and multiply it by 100 to actually get the option's value or option premium. Now let's note that the current Tesla stock price is $811. So the stock price is the current market price of the shares, but we are looking at a call option with a strike price of $800. In the bottom middle of this image, we can see that the option price is $81.70. But remember, this is not the actual value or premium of the option. This is the option price. To get the option's actual value, or the cost of purchasing this option, one contract, is actually $81.70 multiplied by the option contract multiplier of 100, which gives us an option value or option premium of $8,170. Now this is a really expensive option. Now don't worry, because not all options are this expensive, but we'll talk about exactly why this option is so expensive in just a little bit. But why would this option be worth over $8,000? That seems a little bit crazy. Remember, a call option buyer can use the call option to purchase 100 shares of stock at the call option strike price between now and the expiration date. And in this case, the expiration is 39 days away. So let's say that I think Tesla shares are going to increase significantly over the next 39 days. I'm going to buy this Tesla call option right now with a strike price of $800, and I'm going to pay the premium of $8,170 to buy this call option. Just one contract. Now let's say 2 weeks from now, Tesla has had a massive rally in the stock price, and now Tesla shares are trading at $1,000 per share. Well, I have in my possession a financial contract called a call option that gives me the right to purchase 100 shares of Tesla stock at my call option's strike price of $800. But Tesla shares are currently trading for $1,000. So with my option, I could exercise my option, meaning I want to go through with what the option allows me to do, which is with a call option, purchase 100 shares of stock at the strike price. And if I do that, I will buy 100 shares of Tesla stock at the strike price of $800. So if we take $800 per share times 100 shares, I will pay $80,000 to buy that share position. But Tesla shares are currently trading for $1,000. So if I go ahead and turn around and sell my shares, if I sell 100 shares for $1,000 per share, I will receive $100,000 for selling those shares. So my profit in this scenario is $200 per share multiplied by 100 shares, giving me a $20,000 profit. But remember that I paid $8,170 for this option initially, so my $20,000 profit minus my initial cost of entering the trade of $8,170 gives me a net profit of $11,830. If I make a profit of $11,830 on an initial trade cost of $8,170, my return on that position is 145%. So the reason a trader would pay so much for a Tesla call option is because Tesla shares are incredibly volatile and can move around hundreds of dollars in just a few days' time. So if a trader believes that Tesla's stock price is going to surge in the near term, they might buy a call option, and by doing so, if they buy the call option and then the stock price increases significantly, the value of their call option will also surge because the ability to buy shares of stock at the fixed strike price gets immensely valuable as the share price rockets to higher and higher prices. But we need to discuss something that's extremely important, and it's a major sticking point for options trading beginners. And this is that when you are trading options, very rarely will you actually exercise the option to purchase shares of stock at the called strike price and then sell them at the current market price, as I just described in this Tesla example. The reason I described it like that is because as an options trader, you have to understand where the prices are coming from and why the price changes make sense. So in the case of buying this 800 call option when Tesla is at $811, if the stock price goes to $1,000, I have a contract that allows me to buy 100 shares of stock at my strike price of $800. So then I could exercise that right, buy the shares at $800 and sell them at $1,000, which would give me a $200 profit per share. But here's the thing. An option will always include the benefit that it provides the owner in its price. So the option price will always embed any profit that can be made by exercising it. So in the example where I buy the 800 Tesla call option and the stock price goes to $1,000, since I have a call option and the call option can buy shares of stock $200 below the current stock price of Tesla, my call option's price will be at least $200. And that's just the price. So if we multiply by the contract multiplier of 100, we get an option value of at least $20,000. Now it's a law that an option has to be worth at least the benefit that it can provide the owner. And by benefit, I mean if I exercise the option to buy 100 shares of stock at 800 and the stock price is currently at 1,000, the benefit or the profit that I could make by doing so is $200 per share. And that means that the call option's price must be worth $200 or more. So in this Tesla example, I mentioned that I could buy the call option, the stock price increases, that I could exercise the call option. But in reality, you would not exercise the call option. You would simply sell the call option at the higher price, and you would make the difference between your purchase price and your sale price. So it's just like buying shares of stock. When you buy shares of stock, your goal is to see the shares increase in value, and then you can sell the shares at the higher price and secure your profit. With options, it's the exact same thing. 99% of the time, when you are trading options, you will be trying to trade options with the goal of profiting from the price changes of the options. Very, very rarely will you actually want to exercise the option because you don't need to exercise the option because the benefit or the profit that you could make by exercising the option will be embedded in the option's price. So I really want you to internalize the fact that when you're trading options, you don't have to exercise the option to realize the profit. The profit will be realized by selling the option at a higher price if you are buying options. So really quickly, if we just want to fact check what I just said, let's look at an option on Tesla with a strike price $100 below the current stock price. That option is worth more than $100, so that checks out. If we look at a call option with a strike price $200 below Tesla's current share price, that call option is going to have a price higher than $200. So that checks out as well. So I want you to internalize that when you're trading options, you do not have to exercise the option to realize the profit. And 99% of the time, you are going to be trading options with the goal of profiting from the price change in the options, at which point you could close your position and you could realize the profit, which will be the difference between your purchase price and your sale price. So let's take a look and see exactly what actually happened with this Tesla call option. As it turns out, the day after I took the first image, where Tesla shares were at $811, Tesla was actually higher. So I took another screenshot to look at that same call option with the increase in Tesla's share price so that we could see exactly what happened to that call option with the passage of one day and an increase in the stock price. So let's take a look. The stock price in this image is now $836, which is a $25 increase from the Tesla share price of $811 that we just looked at a moment ago. So now that the share price is $836, let's go ahead and go to the June expiration and look at the call option with a strike price of $800 and see exactly how that option price changed given the increase in Tesla's stock price. As we can see, the 800 call option in that June expiration cycle is worth $94.10. And if we multiply that price by the option contract multiplier of 100, we get an option premium of $9,410. So if I purchased that call option just the other day and I paid $8,170 for that call option and held it until today, which is a share price of $836, which is a $25 share price increase from when I purchased the call option, now my 800 call option is worth $9,410. So now I could just go ahead and sell the call option for $9,410, and my profit on that trade would be $1,240. A $1,240 profit on an initial trade cost of $8,170 gives me a return of 15%. But Tesla's stock price itself only increased by 3%. So this is another benefit of trading options, and this is one huge draw of options, is that they give you leverage. So in this case, we saw a 3% increase in the share price of Tesla, but this 800 call option in the June expiration cycle saw a 15% increase in its value. So the stock price went up 3%, but the call option went up 15%, which means comparing the two returns, the return in the call option was 5 times more than the actual return in the shares themselves. This is exactly how options traders make money. They think that something will happen with the stock price. They put on their position. If that happens, their position benefits by seeing an increase in its value, and then they can go ahead and sell their position at the higher price, and their profit is the difference between the two prices. So it's just like trading shares of stock. If you buy a share of stock for $100 per share and it goes up to $125 per share, you can sell your shares for $125 a share, and your profit is the difference, which is $25 per share, or 25%. So it's the same idea with options trading, except with options trading, you have a more narrow time frame because, as I mentioned earlier, with shares of stock, you have no time limit. But with options, since you have to choose an expiration, you do have a time limit, and because of that, it is a more sensitive activity. But the reason people do it, as we just saw in this Tesla example, is that it can leverage your returns if you are right. So through this example, we learned a few things about call options. First is that the first option type is a call option. The second is that the call option has a strike price, and that means that the call option can buy shares of stock at the call option strike price between now and expiration. So that is what a call option does. And because the call option can purchase 100 shares of stock at the call option strike price, if the share price increases immensely, that ability or value is going to be immensely valuable, because if the share price ends up being $200 above that strike price, then you have a financial contract that allows you to buy 100 shares of stock, $200 below the current stock price. And obviously, that's a pretty sweet deal. But also, what we learned was that you do not have to exercise the option to realize your profit, because one of the laws in options trading is that an option must be worth the benefit or the profit that it provides the buyer should they decide to exercise it. So what I mean by that, once more, is that if I buy a call option on Tesla with a strike price of $800 and the stock price increases to $1,000, if I decide to exercise my call option, I will buy 100 shares of stock, $200 below the current stock price. And because that will give me a profit of $200 per share, that call option must be worth $200 or more, meaning that the premium has to be $20,000 or more. And if you look at any call option and you look at the difference between the stock price and the strike price, the option will be trading for at least that amount, because it is a law in options trading that all option prices must include the benefit that they can provide the owner at that moment. And the last thing that we learned about call options is that they provide leveraged returns. So in this Tesla example, the share price increased by 3%, but the call option that we were looking at actually increased by 15%, which means the return in the call option was 5 times higher than the return in the shares themselves. So everything seems great and all, but I know you're wondering, what's the catch? And there is a catch. The catch when buying call options is that you have to be right about the stock price increasing, otherwise you will lose money on that trade. So in the house example, remember that I bought a call option with a strike price of $200,000, and I paid $10,000 in premium for that call option. And remember, in my second scenario, I said that the house price goes to $150,000. But I have a financial contract called a call option that allows me to buy that house for $200,000. But since the current valuation of that house is $150,000, there's no benefit of having my call option, because my call option gives me the right to buy the house $50,000 higher than the current market price of the house. And obviously, I don't even need the option to do that. If I want to buy the house, I can just buy it for the lower price of $150,000, which is the current market price. And in that example, I said that my option would be worthless, and because of that, I lost the entire $10,000 premium for buying that call option on that house when the house price did decrease. So there is a catch when buying call options, and that is that you need the stock price to increase, otherwise you will lose money on that transaction. And we'll talk very in detail later about why buying call options or buying options in general will lose money if the stock price does not change. But for now, I want to focus on teaching you the basic option trades and how the two option types move with the stock price and how traders actually make money when trading options. I need some water, I just talked a lot. All right, let's keep going. So let's go ahead and really quickly look at an example where a call option trade does not make money because the stock price falls. And we'll see exactly what happens to the call options price as that is happening. In this image, we are looking at the shares of Adobe, which has the ticker symbol ADBE, and we are looking at the shares on May 6th. On this date, Adobe shares closed at $362 per share. Let's say a trader thought that the upward trend in Adobe shares would continue, so they went to the May expiration cycle and they bought the 380 call option. So the call option in the May expiration with a strike price of $380. And let's look at a chart of that exact option so we can see how the option price changes as the stock price is changing side by side. On May 6th, the May 380 call option closed at a price of $1.92. So that means the premium or the value of that option is $192, meaning that if I wanted to buy one of these call options, I would need to have $192 available in my trading account. So let's say a trader buys this 380 call option and they pay $192 to enter that trade. As we can see, the option price initially jumped higher as the share price continued higher, but then unfortunately things turned around, the stock price crashed, and with it the call options price decreased as well. The very last data point on this call option chart, the option only had 1 day left until expiration. And with a strike price of $380 and with Adobe shares significantly below that at about $355 per share, the 380 call option with 1 day left until expiration was essentially worth $0. It was just a couple pennies, but essentially that means that the option is worthless. We'll explore exactly why this happens in just a little bit, but for now, just understand that if you buy call options and the stock price decreases and is below the call option's strike price, as the option gets closer and closer to expiration, the option's price will steadily approach $0 or being worthless by the time of expiration. And that's because if the stock price is well below a call option strike price near expiration, there is little value in having that call option because traders don't need the call option to buy shares of stock. So if I bought this call option initially for $192 and a few days later the stock price was way lower, the option was close to expiration, and the option was worth only a couple pennies, then I would have essentially lost 100% of the premium that I paid for that option, since if I buy something for $192 and its value falls to zero, I have lost everything that I put into that position. And if I held this option through the expiration date and the strike price is $380, but the stock price is below $380 when the option expires, I don't have to do anything because the option will simply disappear from my account as it will expire worthless, and I will be left with the full loss of $192 on this trade. All right, let's take a quick breather because I know we just went through a lot of information in a very short period of time, and I want these videos to be information dense, but unfortunately for our brains, that means that we are going to get some headaches. And if your head hurts right now, do not worry about it at all because my head hurts even having 7 years of experience in this industry. Doesn't matter how much experience I have going through these examples and explaining all the numbers, it makes my head hurt too. So let's take a quick breather, take a glass of water, do whatever you need to do, and then let's get back to it. So now we are going to move on to the second option type. So thus far, everything we've talked about has been call options, and particularly buying call options and how that trade works. So now we are going to explore the second option type, which is called a put option. Now if you started to understand how call options worked in the previous section, then you're going to pick up put options just like that because the concepts are all exactly the same except everything is flipped on its head. So with put options, put option prices actually increase as the stock price is falling, and they actually decrease as the stock price is increasing. The reason that is that a put option gives the buyer the right to sell 100 shares of stock at the put option strike price between now and expiration. So while call options allow you to buy 100 shares of stock at the called strike price, put options allow you to sell 100 shares of stock at the put option's strike price. So because of that, put options actually increase in value as the share price is falling because the ability to sell shares of stock at the put option's fixed strike price gets more and more advantageous as the share price is falling. And just like we did for the call options, we are going to look at numerous put option examples so that you can understand and that you can see how these trades perform and what you need to happen to make money when trading put options. So let's get started with an example and look at an image that I recently captured in IWM, which is the Russell 2000 ETF. In this image and in this moment, the first thing that I want you to notice is that the IWM share price is $130.71. Again, we are going to go to the June options, and this time the June options expire in 38 days. In this example, I've set up an order to purchase the June put option in IWM with a strike price of $130. So the stock price is currently $130.71, and the put option trade that I am looking at is buying the put option with a strike price of $130 that expires in June, which is 38 days away. As we can see in the bottom middle of this image, the put option's price is $6.24. But as we've discussed, to get the actual value or the premium of this option, we have to take that price of $6.24 and multiply it by the option contract multiplier of 100 to get the option's cost, value, or premium of $624. And that's because, just like call options, a put option can sell 100 shares of stock at the put's strike price. So the put option contract multiplier is the same as calls, and to get the actual cost or the value or the premium of the option, whatever you want to call it, is the price, which in this case is $6.24, multiplied by the option contract multiplier of 100, which gives us an option cost or premium of $624. And we can verify that this option is worth $624 by looking at the maximum loss on this trading platform. The maximum loss says $624, and when you buy options, the most you can lose is the premium that you pay for the option, as we briefly discussed in the previous call option section. Now you might be wondering, the stock price is currently at $130.72, but the option strike price for the put option that we are looking at is $130. And since a put option gives the buyer of that option the right to sell 100 shares of stock at the put option strike price between now and expiration, why is this put option worth $624 when there's really no value in owning this put option? I could just sell shares of stock right now for $130.72, and I would sell it at a higher price than I could sell these shares for by using my put option. So why is this put option valuable when the stock price is above the put option's strike price? We're not going to talk about it right now, but this is just something I want to put on your radar, because in the next section we are going to dive in exactly why this is. But for right now, I want to focus on how put options work and how their prices change relative to the stock price. But I want you to just notice that the strike price of this put option is $130, but the stock price is currently above that strike price, but this option still has pretty significant value. So I want you to just be aware of that. We're not going to discuss why that is right this second, but if you were wondering why is this put option valuable when the stock price is above its strike price, I want you to know that I hear your questions and we are going to get to it in the next section. But for now, I want to focus on teaching you how put option prices change relative to the stock price and why that happens. So let's go ahead and see what happens with this IWM put option. So a few days later, as luck would have it, I took another screenshot of IWM, and this time IWM had fallen significantly since the first image that I captured, where IWM was over $130 per share. In this image, IWM is currently at a share price of $122.72, which is essentially $8 lower than it was in the first example. If we look at the 130 put option in the June expiration cycle in this second image, with IWM's share price significantly lower, we can see that the 130 put in the June expiration cycle is trading for $11.30, meaning that the option has a value or premium of $1,130. The put option's value surged because the share price of IWM fell. And because put options have the ability to sell 100 shares of stock at the put's strike price, and since the put strike price was 130, since we saw IWM go from 130.71 all the way to 122.72, the put option is now in the money, so to speak, meaning that the stock price is significantly below the put option strike price of $130. And now that this option can actually provide a benefit to the buyer of that option, meaning that if I bought this option a couple days ago for $624 in premium, and now the share price is $122.72, which is way below the strike price of $130, I could use my put option to sell shares of stock at $130, which is immensely valuable because the stock price is currently well below that at $122.72. But remember earlier, I said that you never have to exercise an option to realize the profits. And we can see that is the case because the option in this example with the lower stock price is $11.30. So if I had purchased this put option on day one and I paid $624 for this option, and I held it until this image where it was worth $1,130. If I sold this put option, I would secure a profit of $506 on a $624 initial trade cost. And if I secure a profit of $506 on an initial cost of $624, my return on that trade is 81%. But if we look at the percentage change in the shares of IWM, initially they were at $130.71, but then they fell to $122.72, which is a 6.1% decline in the share price of IWM. But the 130 put option that we were looking at experienced a price increase of 81%. And again, that means that when you buy put options, you have leverage. Now, just like we did with the call option section, I know you're already thinking, what is the catch? And there is a catch, just like with buying call options. When you buy put options, if you buy put options and the stock price does not decrease, you will lose money. So in this example where the IWM share price was $130.71, if I bought that 130 put option for $624 in premium, and at the time of June expiration, IWM was above $130 per share, because I don't actually need to use my put option to sell shares of stock at the strike price of 130, because if the share price is higher than the strike price, I can just sell shares of stock in the open market, and there is really no value in owning my call option. So just like with call options, if you buy a call option and the stock price doesn't increase or decreases, you will lose money. And with put options, if you buy a put option and the stock price does not fall or the stock price increases, you will lose money. So we'll look at an example of that right now. And for this example, we're going to look at a put option trade in NVDA. And obviously this trade is going to lose money, because who is buying puts in NVIDIA? Who is betting against NVIDIA? Come on, man. On May 1st, NVIDIA's share price closed at $283 in the middle of a pretty vicious sell-off. So let's say a trader thought that the downside would continue in NVIDIA, huge mistake, and they went and bought the 280 put option in the May expiration cycle with NVIDIA shares at 283. On May 1st, the May 280 put option, meaning the put option in the May expiration with a strike price of $280, was trading for $11, meaning that I would have to pay $1,100 in premium to buy one of these put options at the strike price of $280 and expiring in May, which had about 2 weeks to expiration at the time of entering this trade. So let's say a trader buys this 280 put option, paying $1,100 in premium for the put option that expires in 2 weeks in the May expiration and has a strike price of $280. Unfortunately, that trader would have lost everything that they put into that trade, because immediately after that sell-off, after May 1st, the stock price did end up surging higher, and therefore the put options price collapsed. And in the most recent date on this chart, we can see that NVIDIA's stock price was at around $321, over $40 higher than the put option strike price of $280. And on the very right-hand side, or the last bar seen in this option chart, the option only had 1 day left until expiration. And with the stock price over $40 above the put option strike price, and with only 1 day left until expiration, the option is basically going to expire worthless, because the stock price needs to fall over $40 for this put option to gain actual value or benefit by the time it expires in 1 day. And because of that, and since there's such a low probability of that happening, we can see that this put option's value 1 day before expiration, and with the strike price $40 below the stock price, that put option was trading for 1 or 2 pennies, meaning that it was essentially worthless. So if a trader bought this put option for $1,100 and they held it until the expiration when NVIDIA was $320 or higher, they would have lost the entire $1,100 premium that they paid for this put option, because the put option would have expired worthless. Now, if the stock price is above the put option strike price at expiration, the put option will expire worthless, meaning that if you have a position in that option, it will disappear from your trading account after the expiration date, and you will be left with whatever profit or loss you had on that position. And in the case of buying a put option, you will have a loss, since if, in this case, you bought the put option for $1,100 and it expired worthless, you would have a loss of $1,100 on that trade. So while you can make significant returns on your investment or trade cost when you are buying put options, obviously you can lose 100% of what you pay for those put options, which means that while you can make 100% returns on the trade cost, you can also lose 100% when you are buying options. But the big benefit of buying put options is that compared to shorting 100 shares of stock, buying put options is far safer by a long shot. If you're not familiar with what shorting stock is essentially betting against the stock, meaning that you make money when the share price falls. But if you short a stock or you bet against the stock price increasing, since there's no limit to how high a stock's price can go, when you're shorting stocks, you have theoretically unlimited loss potential. So in that case, if you were comparing shorting 100 shares of stock to buying a put option, you would have much less risk buying a put option compared to shorting 100 shares of stock. So in this NVDA example, if I shorted 100 shares of stock at $280 per share and the share price went to $320, I would have a loss of $4,000. So a $40 loss on 100 shares would give me a loss of $4,000. But in this example, we saw that the put option purchase only lost $1,100. So when you compare shorting stock to buying a put is, in my opinion, a much better way to do things. If you're unfamiliar with what shorting stock is and how it works, I will leave a link down in the description below so that you can get my video explanation and demonstration of shorting a stock. By the way, you can download a full PDF of all of the slides and the images shown in this presentation. So if you want to download that, you can do so for free and you don't have to put in an email address. To be honest with you, the only reason I would want your email address is to send you my future YouTube videos. So if you download that PDF, I would love to have your support and see you in my future videos by having you as a subscriber. We've covered a lot of content thus far. My head hurts a little bit, but I can still keep going, and I hope you can too. But I want to really quickly just say that if you made it this far, you are doing a great job, because we have discussed the two most basic options trades that you can make, which are buying call options and buying put options. But before getting to the next two options trades that make up the four most basic options trades that you can make, I want to talk more about option prices. More specifically, in the Tesla example, when the stock price was at $811, why was the call option with a strike price of $800, only $11 below the share price, why was that option worth over $8,000? And also, in the IWM example, the stock price was $130.71, but the put option with a strike price below that at $130 was worth $624. So I would like to go and explore those prices with you and explain to you why those prices make sense and where option prices come from in more detail before moving on to the other options trades that you can make as an options trader. So let's get started. In this next section, we are going to be talking about the components of option prices. We've already kind of talked about the real value that an option can provide the owner in certain scenarios, and depending on whether we're talking about a call option or a put option. But as we discussed and as we saw in the previous examples, particularly the IWM example, that does not fully explain where an option's price comes from. So in this section, we are taking a deep dive into option prices, and I am pretty confident that after this section, options are going to make a whole lot more sense to you. So let's dig in. There are two components that make up the whole of every option's price. The first is called intrinsic value, and the second is called extrinsic value. You don't know it yet, but you essentially already know what intrinsic value represents in an option's price. Remember when I had the house example where the house was $350,000 and I had a call option on that house with a strike price of $200,000. In that example, since my call option allows me to purchase the house for $200,000 and the house is currently $150,000 above that at $350,000, we would say that that call option in that example had $150,000 of intrinsic value, meaning that the option contract was worth at least $150,000 because me, as the owner of that option, I could use that option to buy the house for $150,000 lower than the current market price of $350,000. So that is what intrinsic value is. For puts, it's the opposite. So if you have a strike price of $130 and the stock price is at $120, you have a put contract that can sell shares of stock $10 higher than the current stock price, and that has real or intrinsic value equal to $10. So since the put option can sell shares of stock $10 above the strike price, we say that the put option has $10 of intrinsic value. In the Tesla call option example, where I purchased the 800 strike call option and Tesla shares go to $1,000 per share, since that call option has the ability to purchase shares of stock $200 below the current stock price, in that instance, the call option has $200 of intrinsic value. And I also told you that an option's price must be worth the benefit that it can provide the owner at that moment. And what I really meant by that is that an option's price must be worth at least the amount of its intrinsic value, because the benefit that it can provide the owner at that moment, that is the minimum that the contract should be worth. So if I had that Tesla call option with a strike price of $800 and the stock price is at $1,000, since I personally could use that option to make a $200 gain on the shares if I exercise the option, but I don't want the option, I'm not going to sell it to somebody else for any less than $200. And that's because if I use it myself, the benefit to me could be a $200 gain per share. So if I want to sell it to somebody else, it's going to be worth at least that amount or more when I sell it to them. So let's go to that Tesla call option example and let's look at the image where the stock price was currently at around $836 per share. In this image, the share price of Tesla is $836.41. And again, we are looking at the call option with a strike price of $800. Now, because this call option has the ability to purchase shares of stock at $800, but the current share price is $836.41, this call option has $36.41 of intrinsic value. But we can see that the option's actual price is much higher than its intrinsic value because the option's price is currently $94.10 in this image. So the portion of the Tesla call option's price that is above its intrinsic value of $36.41 is called extrinsic value. And extrinsic value is sometimes referred to as time value because it can be associated with the option's potential to become more valuable, particularly intrinsically valuable, before it expires. So in the case of this Tesla call option, there are over 30 days left until that option expires. But right now, in this moment, it has $36.41 of intrinsic value. But since the option's price is currently $94.10, the additional $57.69 in the option's price is extrinsic or time value. Now let's think about this. Tesla shares are incredibly volatile, and with an option that has over 30 days to expiration, there's a lot of time left for Tesla shares to move around a lot. Particularly in the case of this call option, if Tesla were to go to $900, this 800 call option would now have $100 of intrinsic value. So just because it only has $36.41 of intrinsic value right now, there's the potential that the option will have significantly more intrinsic value in the future if Tesla shares increase by a significant amount, which is certainly possible considering that Tesla shares can move around hundreds of dollars in just a few days' time. So that explains why this option has a lot of extrinsic value or time value in its price. The current real value or intrinsic value of this call option is only $36.41 right now, but it has almost $60 of extrinsic value or time value because with over 30 days left until this option expires, there is plenty of time left for Tesla to make a big upside movement, and that would leave this call option with significantly more intrinsic value. So you can think of an option's extrinsic value as the time value or the potential for that option to become significantly more valuable through share price movements between now and expiration. Now this brings us to a very important point about extrinsic value or time value. Options with more time until expiration will trade with significantly more extrinsic or time value compared to the same exact option with less time until expiration. And what I mean by that is if we look at two call options with the same strike price and we look at two different expirations, the call option that has a further expiration date will be trading with significantly more extrinsic value because there's lots more time left for the stock price to move and therefore cause the option to become significantly more valuable, particularly intrinsically valuable. Now, the IWM put that we looked at earlier, it should make complete sense why the put option was worth $624 when the strike price of the put was $130, but the price of IWM shares at that moment were actually above $130. The reason that the put option was worth $624 is because it had over 30 days to expiration, and in a 30-day time period, especially right now during the coronavirus pandemic and the market volatility that we're seeing, there is certainly a good possibility that IWM falls significantly, and for that reason, that 130 put option would become significantly intrinsically valuable. And that's exactly what we saw happen. So the reason that the put option was valuable, even though it did not have any intrinsic value, is because it still had lots of time left, and since the strike price was close to the stock price, any downside movement in the stock price would leave the option intrinsically valuable, which, as we know, is exactly what happened. So if an option doesn't have any intrinsic value, it doesn't mean that the option isn't worth anything, because if it has lots of time left until expiration, then there's still lots of time left for the stock price to move, and that could leave the option with intrinsic value or real value. But as we saw in our losing call option and put option examples, if an option does not have any intrinsic value, but also does not have a lot of time until it expires, then there is very little time for that stock price to move, and therefore there's very little time for that option to actually become intrinsically valuable. Now, one of the most important concepts to understand in options trading is what we call extrinsic value decay or time decay. As I've just described, options with more time until expiration will trade with more extrinsic value or time value, and I also said that options that are expiring very soon will not be trading with significant levels of extrinsic value or time value because there's not a lot of time left for the stock price to move, and therefore there's not a lot of time left for the option to become intrinsically valuable. So to look at some real examples, as I like to do in this video, let's look at some Apple call options, and we'll look at a call option with the same exact strike price but in different expiration cycles, and we'll compare the values of those options. In the exact moment that I took this screenshot, Apple shares were currently trading for $304.92. And I have opened up a couple different expirations so that we can compare the option prices. So let's focus on the call options with the strike prices of $305. And since the stock price is below $305, these call options have 100% extrinsic value. So since they don't have any intrinsic value because the stock price is below the strike price, the prices of these options are entirely extrinsic. meaning that they are entirely associated with the time left until expiration and for the possibility that Apple could make a big movement over those specific time periods. As we can see, the call option with a strike price of $305 in the January 2021 expiration cycle is trading for $34, meaning that the cost or premium of that call option is $3,400. So this option has 246 days until expiration, and since there's 246 days left until expiration and the stock price is already right at the option strike price, with over 200 days left until the option expires, there is plenty of time for Apple to make a big stock price movement, particularly to the upside, which could leave this option with significant intrinsic value. So the reason that this 246-day call option is worth over $3,000 is because Apple can make a pretty large move in the stock price over a 250-day period as compared to a one-day period. So the option prices will reflect this. If we look at the 305 call option in the May expiration cycle, this option expires in 1 day, and the cost or premium of that option is $307, which is the price of 307 times 100. So if we compare the 1-day 305 call to the 246-day 305 call, we can see that the 246-day call is about 10 times more expensive than the 1-day 305 call. And that's because with 245 more days until expiration, there is a greater potential value in the 305 call expiring in 246 days as compared to the 305 call expiring in 1 day. So the reason that the 1-day call option with a strike price of 305 is only worth 307 is because Apple's not going to make a $100 movement in the stock price over the next 1 day. But over the next 246 days, that is a much higher probability of actually occurring. So the reason that a longer term option will trade with more extrinsic value or time value is because there's a lot more time left for the stock price to move, and because of that, there's a lot more time left for the option to become intrinsically valuable. So if we can imagine that I buy that 246-day call option for $3,400 and hold it until it only has 1 day left until expiration, and Apple is still right at $304.92, then we could think that I would lose about $3,100 on that position. And that's because if I buy a call option with 250 days to expiration, that is 100% extrinsic value, and I pay $3,400 for that option. But with 1 day to expiration, that same option is worth $300. Well, I will lose $3,100 on that trade simply from the passage of time. And that is called extrinsic value decay or time decay. So that just means that as time is passing and as an option approaches its expiration date, it will trade with less and less extrinsic value because its final valuation is becoming more certain. And what I mean by that is if an option has 10 minutes left until expiration and it has $0 of intrinsic value, there's a good chance that in the next 10 minutes the option is not going to be worth anything, and because of that, it's going to be trading with very, very little extrinsic value. But if that same option had 10 days to expiration, then it would probably be trading with a lot more extrinsic value because there's a lot more time left for a stock price movement to occur that could leave the option with intrinsic value. So in the sections of buying call options and buying put options, I had stated that when you buy a call option or you buy a put option and the stock price does not move, you will lose money. And the reason you will lose money is because if you buy a call option or buy a put option, that option is going to have some extrinsic value or time value in it, especially if you are buying an option that is not in the money or has intrinsic value. And because of that, as time passes, the extrinsic value will come out of that option, leading to a lower overall option price. And if you buy something and its price falls, you will lose money. So in the next sections, we're going to cover the other two options trades that you can potentially make or that will make up other strategies that you'll learn about in the future. And these strategies will actually make money when the option prices are decreasing from the passage of time and from the decrease in the extrinsic value of the options. So the next two strategies that we're going to learn, which are completely opposite of the first two that we learned, will actually benefit from the loss of extrinsic value as time passes and as an option approaches its expiration date. But first, I want to familiarize you with three terms that options traders use quite frequently that describe if an option has intrinsic value or only has extrinsic value. And these three terms are in the money, out of the money, and at the money. So these terms describe an option strike price relative to the stock price, which essentially describes whether or not they have intrinsic value or not. So in the money is any option that has intrinsic value. So in our Tesla call option example, if the strike price of the call option is 800 and the stock price is at 836, this option has $36 of intrinsic value, and for that reason we would say it is in the money. But out of the money is the opposite. Out of the money refers to any option that does not have intrinsic value and therefore only has extrinsic value in its price. So an example of an out of the money option would be the IWM put option that we looked at earlier. The stock price was at $130.72, and we looked at the option, the put option, with a strike price of $130. At that moment, the put option did not have any intrinsic value in its price, and therefore it is said to be an out of the money option. But the last term is called at the money, and an at the money option is any option with a strike price that is equal to or very close to the current stock price. So based on that definition, we could also say that the IWM put option was at the money since the stock price was near 130 and the put option strike price was also near 130. So I just wanted to familiarize you with these terms because you will hear them at some point, and I know the jargon and the confusing terms can be confusing, but as an options trading beginner, it is very helpful to learn these terms because you will understand what people are talking about when you hear them. Okay, so these next two sections are very confusing for beginners because, as you'll learn, we don't always just have to buy options. We can actually bet against an option's price, meaning that we put on a trade that profits when the option price falls. So thus far, we've only talked about options from the perspective of buying them. And similar to buying shares of stock, if I buy shares of stock, I make money if the stock price increases. But that's not the only way I can participate in the stock market. I can also short stocks, meaning that I can sell them first without owning them, and if the share price falls, I can make money on that transaction by purchasing the shares or closing my position at a lower price. So if I short a stock at $100 and it falls to $90, I can buy back the stock for $90 and I will make $10 per share. So the same thing can be used in options trading where we can bet against an option price and therefore we can make money when the option price decreases. This is called shorting options, and it is done by selling an option that you don't own. So you are selling an option as an opening trade, and your goal is to buy back the option or close it at a lower price in the future. So if I sold a call option for $5, meaning I collect $500 in premium, and later the option price is worth $3 or has a premium of $300, I could pay $300 to close the option. And since I collected $500 initially and I paid $300 to close it, my profit on that trade is $200. In this image, I have an order to short the 125 strike call option in IWM that is expiring in June, which has 36 days until expiration. As we can see, the current share price of IWM is $120.59. So first of all, what does that mean about the call option's price? Does it have intrinsic value or is it only extrinsic value? Well, since the strike price is $125 and IWM stock price is at $120.59, this call option's price is 100% extrinsic value or time value. And as we discussed in the last section, time value or extrinsic value comes out of the option price as it approaches expiration. In the bottom middle of this image, we can see that the price of this 125 call option is $4.66. And that means that the option's cost or premium is $466. Now, when you sell or short an option, meaning you sell it as an opening trade, you don't pay the premium, you collect the premium. But in this case, since the option premium is $466, if I sell this call option short, I will collect $466 into my account, and that will be the start of the trade. But just because I collect the premium, it does not mean it's a profit. I have to close the trade later for a lower premium to realize a profit. As the option price falls, if the stock price remains below 125, as the option price decreases in value, my profit on that position will increase. It is a very fluid process, and it doesn't happen, it's not a binary thing where you only get the profit at expiration. It happens in real time and as the option price is changing. But more importantly, this is an incredibly risky strategy. Since there's no upper limit to how much a stock's price can reach, when you short a stock or bet against a stock's price from increasing, you theoretically have unlimited risk. And since call option prices are tied to the stock price, meaning that if the stock price increases significantly, the call option will take on intrinsic value and become more valuable. But since there's no upper limit to how much the stock's price can go, the call option's price also has no upper price limit. To get an idea as to what this 125 call option would be worth, if the stock price were at its current level, but the option only had 1 day until expiration, let's just go ahead and open up the 1-day expiration cycle and look at the price or value of the 125 call option that expires in 1 day. In this expiration, we can see that the 125 call option has a price of 23 cents, which means its value or premium is $23. So if I shorted this 125 call option, collected $466, and 30 days later, or when the option had 1 day left until expiration, the option was only worth $23 in premium, I could buy back the call option that I shorted and pay $23 to close the trade. And because of that, my profit on that position would be $443. But really quickly, I want to mention that with this strategy, since it is so risky, you have to have a margin account, and that means you have to be able to put collateral aside to enter that position. So on this trading platform, it's saying that the buying power effect will reduce my available buying power by about $2,000. Now all that means is that I need $2,000 in available cash or option buying power that I can set aside to enter this position. So if I want to sell this 125 call option short and collect $466, I have to set aside $2,000 in my account to account for potential losses in this extremely risky position. So it is an expensive trade to enter in terms of the amount of money that you will need, but I just wanted to mention that really quickly so that you can understand kind of the logistics around shorting options. So hopefully thus far you can understand that when you buy options, it's a buy low, sell high approach. You buy the option, you hope that the option price increases, and then you can sell the option at a higher price and pocket the difference in your purchase price and sale price. Shorting options is the exact same, but it's in reverse. So you sell first with the goal of buying low later. So you want to sell an option short, you're betting that its price will fall. If the price does fall, you buy it back at a lower price. But what happens if the stock price does increase significantly after you've shorted a call option? Well, let's look at a real example, and let's go to Netflix. The very left-hand side of this chart is April 9th, and on that day, Netflix shares closed around $370 per share. Just a few days later, Netflix was considerably higher, closing around $440 per share. What do we think happened to a call option in Netflix with a strike price of $400. Let's go ahead and look at a chart of the price for the June 400 call option in Netflix through this same exact time period just to see what happened. So this chart is the June 400 call option in Netflix. On the very left-hand side of the chart is again April 9th. On that day, this 400 call option, expiring in June, closed at a price of around $17, meaning the premium was around $1,700. So let's say I was a trader who believed that Netflix was not going to increase above $400 through the June expiration, and I thought Netflix would either trade sideways or even trade lower, leading to a decrease in the call option's value over that time period. So to enter this trade, I would short the June 400 call option for its premium of $1,700. So I short the option for $17. I collect $1,700 in premium, and my goal with that trade is to see Netflix shares decrease or not increase above my call strike price of $400 or through the expiration date in June. Unfortunately, if we fast forward a few days, we can see that Netflix shares actually closed at $440, and at that time, the Netflix call option that I was short reached a price of $62.50. If we multiply that by 100, we get a premium of $6,250 on that June Netflix 400 call option. So since the stock price was around $440 and I was short the 400 call option, we know that at this moment in time, the call option had $40 of intrinsic value, but since its option's price was $62.50, the additional $22.50 is extrinsic value or time value. So unfortunately, if I would have shorted this call option for $1,700 and its price increased to $6,250, I would have a loss on my short call position, just one contract, of $4,550. So this really highlights the risk of shorting call options. If you short call options, you are essentially betting against an increase in the price of the stock, and if you're right, you will make the premium that you sold the call option for, as the extrinsic value will come out of the option as time passes. But if you're wrong and the stock price does surge higher, as it did in this case, then you will lose considerable amounts of money, especially if it's a huge stock price increase in a short period of time, such as the case in this call option or Netflix example. So I shorted the call option for $1,700 in premium. The stock price shot $40 higher than my strike price, increasing a total of $70 in just a few days. And because of that, the call option only approached expiration by a few days, but the price of the stock increased significantly and was considerably higher than the strike price. And because of that, at that moment, the option price was $62.50 or had a premium of $6,250. So just on one of these trades, if I shorted the option for $1,700 and the option price or premium increased to $6,250, and I didn't want to deal with any more losses, and I bought back the option for $6,250, I would have lost $4,550 from this trade and on just one contract. Really quickly before we move on, I want to mention that it is possible to make money on a short call position even if the stock price is above the strike price due to what is called the break-even price. If you short an option for $17, meaning in this call option example, if I short the Netflix call option with a strike price of $400 and I sell it for $17, then what price does the stock price have to be for the option to be worth $17 or less at expiration? Well, it's the short call's strike price of $400 plus the option price that I sold it for, which is $17, and that gives me a break-even price of $417. Why is that the break-even price at expiration? Well, it's because at what price does Netflix stock have to be for the 400 call to have intrinsic value equal to what I sold the option for? Meaning if I sold the option for $17, at what price does the option have $17 of intrinsic value? Well, it's the strike price plus what I received for selling the option. So it's $400 plus $17 gives me a break-even price of $417. So if Netflix was at $417 at the June expiration, my 400 short call option would have $17 of intrinsic value, no more time value or extrinsic value, which means its price would be $17. And if I initially sold it for $17, I don't have a profit or loss. So what if Netflix shares are at $405 at expiration? Well, the 400 call option would have $5 of intrinsic value, no more extrinsic value, which means I would have a $12 profit on my short call position. So if I sold the 400 Netflix call for $17, but the call option was only worth $5 at expiration, then I have a $12 profit on the option, meaning that I actually have a $1,200 profit when considering the option contract multiplier. So if I short the option for $1,700 in premium and at expiration it only has $500 of value or premium, then I have a $1,200 profit on that position. So I just wanted to point out that you can make money on a short call trade if the stock price is above the strike price, but it just has to be below your break-even price. And the break-even price for a short call position is the call's strike price plus the price of the option when you sell it. All right, we got to move on to the fourth and final basic options trade that you can make. And thus far, we've talked about buying call options, buying put options, shorting call options. So the fourth and final one, as you might be able to guess, is shorting put options. So this is selling put options as an opening trade, and your goal is to buy back the put option at a later date for a lower price or paying a lower premium to close that position. And since put option prices increase as the stock price falls and decrease as the stock price increases, when you short a put option, you are putting on a bullish trade, meaning that you are putting on an options trade that will profit if the stock price increases or at least remains above your short put's strike price as time passes. Because in that scenario, the options price will be 100% extrinsic, and as time passes and as an option approaches its expiration date, the extrinsic value or time value will approach zero. So let's go through an example to see exactly how this works. For this example, we will look at a put option in Activision, which has the ticker symbol ATVI. The very left-hand side of this chart is April 27th, and on this day, Activision shares closed at around $67 per share. So let's say I was a trader who wanted to profit from an increase in the share price of Activision, but I also was not super sure that the stock price was going to increase, and I wanted to put on a position that would make money so long as the stock price remained above a certain price. For this type of trade, shorting a put option is perfect. For this trade, we will look at a put option with a strike price of $65, which is just a few dollars below Activision's share price of $67, and we're going to look at that put option in the May expiration cycle. Because we are looking at the May expiration cycle and the trade entry date is April 27th, this put option at the time of entry will have a little bit over 2 weeks to expiration. So let's say I shorted this 65 put option in the May expiration cycle, and I did that while Activision shares were at $67. In this chart, we are looking at the price changes of that May 65 put in Activision. On the very left-hand side of the chart, which is April 27th, we can see that the put's price closed around $1.75, meaning that if I shorted this option, I would collect a premium of $175. Briefly, during the short call example, I mentioned the break-even price, which is the expiration price of the stock, where I will not make or lose any money on my option position. And for the short call position, I said it was the call's strike price plus the price received for the option initially. So in the case of the Netflix call, the strike price was $400, and I sold the option for $17 initially. So therefore, the break-even price was $417. For shorting puts, the break-even price is the put's strike price minus the price that you receive for selling the option. And that's because put options have intrinsic value when the stock price is below the put's strike price. So in this example, if I short the put option with a strike price of $65 and the price of that option is $1.75 when I sell it, then my break-even price on this trade is $63.25, meaning that if Activision is at $63.25 at expiration, my short 65 put will have $1.75 of intrinsic value, and therefore I won't make or lose any money on this trade. But that's at expiration, not before expiration. But I just wanted to mention the break-even price. On May 1st, Activision shares had actually fallen, and the 65 put was actually trading for $3.82, meaning that the premium or value of that put option was $382 at that moment. If I short a put option and collect $175 in premium, but the premium of that put option increases to $382, I will have a $207 loss for every put option that I shorted. So at the moment where this May 65 put option in Activision was worth $382, since I initially shorted it for $175, I have a loss of $207 per contract at this moment in time. But fortunately, Activision shares turned around and they increased pretty significantly and in a short period of time. And as we can see, the price of the 65 put option that I shorted collapsed. And that's because the stock price rallied really high relative to the put strike price, reaching a price of $72.59 in the shares, and with my put strike price being over $7 below that at $65, and since the option only had a few days left until expiration, there was virtually 0% chance that the option would become intrinsically valuable by expiration. Not 0%, but really low. And because of that, the option was trading with very little extrinsic value, and we can see that by looking at the price of this put option on the final days that we have the data for. So on the last bar on the very right hand side of the put option chart, we can see that the put option was only trading for a few pennies. So let's say I bought back this option for 2 cents, therefore paying a premium of $2 to close the short put option. Since I initially shorted the put and collected $175 in premium, and then I later closed it by paying $2 in premium, my profit on the trade is the difference between those two money flows, and in this case, that means I make $173 on this put transaction. I could have just simply allowed this put to expire worthless by holding it through expiration, and therefore I would have made the full $175 profit, because if I short a put option for $175 in premium and it expires with a value of 0, then I make the difference between those two prices, which is $175. But as I mentioned, I would not advise holding short options through expiration, because even if it's only worth a couple pennies, if for some reason Activision shares went from $72.59 and they fell to $60 during that 1 day period, well then my option with a strike price of $65 would be worth $5 because it would have intrinsic value, and that means the premium would be $500. And since that's $325 more than I shorted the option for, I would have a loss on that position. So even though I can just simply allow the short put to expire worthless and make the additional $2 in profits, it is not worth it, because you never know, and if the stock price did collapse, that full winner, or essentially 99% winner, could have gone to a significant or sizable loser. So for that reason, I would always recommend closing option positions before expiration. So at this point in the video, which is obviously more of a class at this point, we have learned the 4 basic option trades. So give it up for yourself if you made it this far, because you have absorbed a ton of content, and now you have seen 4 examples, or you've seen examples for 4 of the most basic option trades that will make up every single option strategy that exists. So buying calls, buying puts, shorting calls, and shorting puts are the 4 building blocks of every single option strategy. So the first step in your journey is to understand very clearly how these strategies work and how you can expect them to make money or lose money in certain scenarios. And I really hope that the examples thus far in this video have helped you to accomplish that, even in a short period of time, such as an hour or 2 hours, however long this video ends up being. But if you've made it this far, you have learned a ton. Up to this point in the video, we have talked about a ton of different things. More specifically, the 4 basic options strategies. We have talked about intrinsic value and extrinsic value, and how extrinsic value decays away as an option approaches its expiration date, and why that makes sense. But now we need to discuss something called implied volatility, which you should not be intimidated by this term because I'm going to explain it to you very clearly in just a second. But implied volatility concerns itself with option prices, particularly how we can look at 2 different stocks and understand why their option prices are different, and understand a metric called implied volatility that essentially nicely summarizes to us how the 2 options on these stocks compare. So do not be intimidated by the word implied volatility, but it's a very important topic because we need to further understand option prices. The first step in understanding option prices was talking about intrinsic value and extrinsic value, but now we need to talk about implied volatility. So do not be intimidated by the words implied volatility. If we use different words to swap out implied and volatility, we would get expected magnitude of stock price fluctuations. So we could swap out implied for expected, and we could swap out volatility for magnitude of stock price fluctuations or changes. So implied volatility is essentially the market's expected magnitude of a stock's price changes in the future. And what is the market, or how is the market telling us that it is expecting these stock price fluctuations? Or what is implying the level or magnitude of these stock price fluctuations? Well, it's the stock's option prices. Let's look at 2 similarly priced stocks, because options are somewhat a function of the stock price, because a 10% move in a $100 stock is $10, but a 10% move in a $1,000 stock is $100. And because of that, the option prices on 2 different price stocks will be drastically different simply because they are different priced stocks. So let's go ahead and look at 2 similarly priced stocks and look at the options in those stocks with the same strike price and the same amount of time until expiration, and see what we find. The first stock that we were going to look at is Visa with the ticker symbol V. And as of this image, Visa shares were trading around $179. So let's go to the June expiration cycle in Visa's options. In the June expiration cycle, which had 36 days until expiration, the 180 call option, or the call option with a strike price of 180, was trading for $7.35. Now keep in mind, since the call option strike price is above the current stock price, we are looking at an out-of-the-money call. And that means this $7.35 price we are seeing is 100% extrinsic value or time value. And also, I just said that the option was out of the money, but I also mentioned that options with strike prices near the stock price are referred to as at the money. So you could say this is an at-the-money call option in Visa, since the stock price is $179, and we are looking at a call option with a strike price of $180. But since the call option is only extrinsic value, it is technically out of the money as well. So this is our first stock in our comparison. Our second stock that we are going to look at is Teladoc Health, which has the ticker symbol TDOC. So as of this image, Teladoc shares were also trading around $180. So just like we did with Visa, let's go to the June expiration cycle with 36 days to expiration and look at the price of the 180 call. So the call option with a strike price of $180 expiring in June, which is 36 days away. As we can see here, the 180 call option in Teladoc that expires in June is trading for $15.45. And as we just saw, in Visa, which was trading for essentially the same stock price and has a June expiration cycle with options that have the same amount of time until expiration as the ones we are looking at in Teladoc, that 180 call option was trading for $7.35, but in Teladoc, the 180 call option with the same amount of time until expiration is trading for $15.45. So the call option in Teladoc with the same strike price and time to expiration as the Visa call option that we looked at is trading for twice as much. So the extrinsic value in this call option is twice that of the call in Visa. So if I wanted to buy one of the Visa call options, I would need to pay $735 in premium, but for the 180 call option in Teladoc, with the same amount of time until expiration, I would need to pay $1,545 for one contract. So why is this? We would say that Teladoc has higher implied volatility than Visa. And what that means in plain English is that the market is expecting larger stock price changes over the next 36 days in Teladoc shares as compared to Visa. And how do we know that? We know that because the option prices in Teladoc are twice as expensive as the options in Visa. And as we have discussed earlier, time value is associated with the option becoming intrinsically valuable or significantly intrinsically valuable before it expires. So the fact that the 180 call option in Visa is trading for $7.35, but the Teladoc 180 call option is worth $15.45, and both of these call options have the same amount of time until expiration, this tells us that the market thinks that Teladoc shares could increase significantly more as compared to Visa shares in the same amount of time. And this is called implied volatility, which again is the market's expected magnitude of stock price movements in the future. So since Teladoc's options are twice as expensive as the ones in Visa, we know that the market is expecting much larger stock price fluctuations in Teladoc shares as compared to Visa. But why would the market think this? To understand why this could be the case in Visa and Teladoc, let's look at the volatility or the daily price ranges of Teladoc shares and Visa shares over the same period of time. So what I'm going to do is I'm going to plot the high to low stock price range in Teladoc and then the high to low stock price range in Visa every single trading day over the past few weeks. And we are going to look at the basic stock price ranges for these stocks over the same period of time to see if we can learn something about the volatility that has historically been observed in these stock prices. As we can see in this visualization, the high to low range in Teladoc shares has been significantly higher on every single trading day as compared to Visa shares. For example, on May 14th, the high to low stock price range in Visa, meaning the highest price of the shares subtracting the lowest price of the shares on that trading day, was somewhere around $6. So Visa shares traded in a $6 range on May 14th. But if we look at the high to low range seen in Teladoc shares, we can see that the high to low range was somewhere around $13 to $14. So the stock price range in Teladoc on May 14th was twice the magnitude or twice the range as the daily range seen in Visa shares on that same day. That is a measure of stock price volatility, how much the stock price has moved on a trading day. Now, I'm not saying that the option prices are looking at this chart and they are saying we need to pay twice as much for Teladoc options as compared to Visa options, but I decided to make this visualization to cleanly describe why the options on Teladoc are much more expensive than the options on Visa. And very simply, it's because the observed volatility in Teladoc shares has been significantly higher than the observed volatility or stock price changes that were seen in Visa over the same time period. All right, so implied volatility is the market's expected magnitude of stock price fluctuations. And what is implying the magnitude or expected magnitude of the stock price fluctuations in the future? It is the option prices. So in the options world, when you look at two similarly priced stocks and one has significantly more expensive option prices than another stock that has the similar share price, then the one with more expensive options has higher implied volatility, and that just means that the stock market or the market is expecting that stock to experience much larger stock price swings compared to a stock with lower levels of implied volatility. And typically, that implied volatility will be directly tied to the observed volatility in that stock. As we just saw in Visa and Teladoc over the past few weeks, Teladoc shares have seen much larger daily ranges in the stock price as compared to Visa, and they are similarly priced stocks. So because of that, the option market or option buyers are willing to pay higher premiums for Teladoc options as compared to Visa, and also option sellers or people that are shorting options are demanding higher premiums to take the risk of shorting options on the higher volatility stock, which is Teladoc. So anytime you see two similarly priced stocks and one has significantly higher option prices, it's because that stock is probably a lot more volatile, and the market, particularly options traders, are willing to pay much higher premiums for those options because since the stock price is moving around a lot more, those options have the ability or the potential to become significantly intrinsically valuable before they expire. So that is just a very high level. I'm not going to go super deep on implied volatility in this video. I do have many other videos in my channel, and I will link my most recent one below so that you can get a full deep dive into implied volatility. I think it's an incredibly important topic for you to understand, but I wanted to bring it up because when we are trading options, we can make money or we can lose money from the changes in the stock price. We can also make or lose money from the passage of time, which is quite literally the extrinsic value or time value coming out of the options. But we can also make or lose money in options trading from a change in implied volatility. And a change in implied volatility quite literally means that the option prices are changing. So in our Teladoc and Visa example, Visa's 180 call option was worth $7.35, and Teladoc's June 180 call option was over $15. So because of that, Visa's implied volatility is lower than Teladoc's. And what I'm saying by a change in implied volatility is that if the market learned of some new news related to Visa and they expected significantly more stock price movements from Visa in the future or through the June expiration cycle, let's say that options traders started to buy up those options aggressively. And because of that increased demand, the option prices in Visa would increase, meaning the extrinsic value or time value would increase in Visa's options. So if we hold the stock price to the same and we are looking at one single trading day and Visa's call option with a strike price of 180 went from $7.35 to $15, that would be called an increase in implied volatility. And it is quite literally the options are getting more expensive relative to the amount of time they have until expiration, and that tells us that the market is expecting greater levels of volatility in the stock price going forward. So if I bought an option, so I bought that 180 call option for $7 and the news came out, but the stock price stayed the same and no time passed because we're looking at one trading day, and that 180 call option went from $7 or having a premium of $700 all the way up to $15 or having a premium of $1,500, obviously, since I own that call option, an increase in its price is advantageous to me and I will profit from that. So when you are buying options, you can make money from an increase in implied volatility, which literally means that the option prices are becoming more expensive because the market expects greater levels of volatility from that stock in the future. But on the flip side, you can lose money from a decrease in implied volatility or a shrinking of option prices when you buy options. So if I bought a call option and the stock price didn't change, but all of a sudden the market expected significantly lower levels of volatility in the stock price going forward, the option prices, particularly the extrinsic value, would collapse, and because of that, I would lose money on the decrease in my call option's extrinsic value because the implied volatility or expected volatility for the stock is decreasing. So when we are trading options, it's important to be aware of implied volatility because some traders like to buy options when implied volatility is really low, and they like to do that because they think that they can make money when the implied volatility reaches higher levels. And on the flip side of that, traders like to short options or sell them and bet against an increase in their prices when implied volatility is incredibly high. Because if you short options when their prices are extremely expensive, meaning that there's high implied volatility, if you short the options and then a few days later the implied volatility is lower, meaning that the market is expecting lower levels of volatility in the stock price going forward, then you will make money from a decrease or shrinking in the valuations of those options. And you can do so without any change in the stock price or without any passage of time, because implied volatility changing literally means that the option prices are changing. And really important, changes in option prices are what drive changes in implied volatility. It's a confusing topic for beginners and for a lot of options traders, to be honest, that implied volatility somehow changes option prices, that this percentage is just changing and the option prices are following it. But in reality, the option prices changing is what is causing the implied volatility to change. So an insurance premium could be another analogy. If I am working out a lot and I'm living a very healthy lifestyle, my implied volatility, so to speak, or the amount of insurance premium that I have to pay for my insurance will be low because I'm a healthy individual and there's probably not a high probability that my health will deteriorate because I live a healthy lifestyle. So we could say that the low insurance premium is low implied volatility, meaning that there is not a lot of volatility or negative consequences expected for my health. But let's say I change my lifestyle and the next time I go to the doctor in a year, I have admitted to them that I am no longer working out, I am not eating healthy, and I'm living a very unhealthy lifestyle. Well, they're going to demand a higher premium for my insurance because now I have more risk. So there's more risk for my health deteriorating and for me to actually need to file insurance claims. And because of that, they are going to ask me to pay higher premiums for my insurance. So we could say that is high implied volatility. So the insurance premium going from cheap to expensive, that's what causes the implied volatility to increase. And vice versa. If I started unhealthy and my insurance premiums were high, that would be high implied volatility. But as my characteristics changed and as I became healthier, I could pay less money in insurance premiums, and we would call that lower implied volatility. So the insurance premium going from high to low is what causes the implied volatility to decrease. I left a video in the description below where I do my deep dive into implied volatility, and so you can learn about it in depth, but I'm not going to dive deep into it here because that would add probably another hour or 2 hours to this video, and it's already been long enough. So if you made it this far, congratulations, you have learned so much about options trading, and honestly, I'm giving you all the information that I've learned over the past 7 years, and I am packaging up all of my aha moments for you so that you can learn basically the most important options trading concepts in just a few hours, and all those light bulbs can turn on for you much faster. So I really hope all these explanations and examples are really helping you understand how the world of options work and operate in the real world. We've got a couple more topics to go through before wrapping up this video. The next couple things I want to talk about very quickly are what happens at expiration, which we've already kind of talked about, and I want to talk about exercise and assignment. And some people will think it's crazy that I waited this long in the video to talk about exercise and assignment, but the reason I waited this long is because when you are trading options, and as I mentioned earlier, 99% of the time you are not going to exercise an option. And because of that, and because most traders do not exercise their options, when you are shorting options, most of the time you do not have to worry about being assigned. So I did not go into detail into explaining these more boring concepts early in the video because frankly you're not going to use them that much, but it is important to understand what happens when you exercise an option, and we've already talked about that in regards to buying call options and buying put options, because the ability to exercise the options is exactly why the option prices make sense and why they change as the stock price reaches various levels. So, as we already discussed, exercising an option is when you own an option. So the people that can exercise options are those that own the options. So if I buy a call option or I buy a put option, I am the one that decides if I want to exercise the option and therefore buy 100 shares of stock at the strike price if it's a call option, or sell 100 shares of stock at the strike price if it is a put option. But there is a balancing act to every single trade that happens, and if I buy 100 shares of stock by exercising my call option, somebody who is short that same option is selected at random through a complex process, and that person will get assigned. And what will they get assigned? They will get assigned or obligated to fulfill the opposing share position that I just took. So if I exercise a call option, I buy 100 shares of stock at the strike price, and that means somebody who was short that same exact option is selected at random, because there could be thousands of people who are short that option that I exercised. One of them is selected at random, and they are assigned a short stock position, or they sell 100 shares of stock at the strike price when they are assigned. So I will no longer have my option. I will have the stock price, or I'll have the stock position, and they will no longer have their short call position. They will be given negative 100 shares, or they will sell or short 100 shares of stock at the call's strike price. So that is called assignment. For put options, if I exercise my put option, I sell 100 shares of stock at the put strike price, and I no longer have the option. So I just have my short stock position if I didn't have any shares, or if I already had 100 shares and I exercise my put, I effectively sell my 100 shares at the put's strike price. But somebody who was short that option will get assigned. So if there's 1,000 different traders and they all have one contract that they were short of that put contract, and I exercise that put, one of them is selected at random, and since they are assigned, and I sold 100 shares of stock at the put strike price, a short put trader will buy 100 shares of stock at the put's strike price if they are assigned. So this is exercise an assignment very basically, and this is exactly what happens when an option is exercised. If an option is exercised by the buyer, someone who is short that option is assigned the opposing stock position that the exercising party took on. So for a long call option, or someone who owns a call option, if they exercise the option, they will buy 100 shares of stock at the called strike price, meaning someone will get assigned a short stock position of 100 shares at the called strike price. For put options, if somebody exercises the put, they sell or short 100 shares of stock at the put strike price, which means somebody who was short the put option will get assigned 100 shares of long stock, meaning they will buy 100 shares of stock at the put's strike price, and they will no longer have the option. So at expiration, any option that is 1 penny or more in the money, meaning if it has intrinsic value of 1 penny or more and it is held through expiration, those options are automatically exercised. So if I owned a call option with a strike price of $105 and the stock price on the day of expiration closed at $105.01, then my 105 call option would automatically get exercised, and because of that, I would buy 100 shares of stock for $105 per share, which is my strike price. And a trader who was short that 105 call option and held it through expiration would sell short 100 shares of stock at 105 per share. Or if they already owned 100 shares, they would effectively sell their shares of stock. So when you're looking at expiration, and this is why I recommended that you don't hold options through expiration, is that if they are in the money, meaning they have intrinsic value of 1 penny or more, those options, if held through expiration, will automatically be exercised, and for that reason, you will end up with a stock position corresponding to whatever option position you had. So that is what happens at expiration, and that is exercise and assignment in a nutshell. But the reason, and I'm going to mention this really quick, but I just did a full video that I really think you should watch on why options are not exercised in most cases before expiration. It's because they have extrinsic value. So a really quick example, if I own a call option with a strike price of $100 and the stock price is at $105 and my option is worth $10, $5 of the option's price is intrinsic and the other $5 of the option's price is extrinsic. And if I exercise my option, I will essentially forfeit my option position and I will go through with buying 100 shares of stock at the strike price of 100. But since the option or the stock price is actually 105, I'm essentially buying 100 shares of stock $5 below the stock price, which is a benefit to me of $500. But I just gave up a $1,000 option to do that, and by doing so, I effectively just gave up $500, which is the extrinsic value, for no reason. So options that have lots of extrinsic value in their prices, which means they have lots of time left until expiration, or they are at the money or out of the money, or even slightly in the money, those options will have lots of extrinsic value, and because of that, they will not be exercised, because whoever exercises that option will actually give up the extrinsic value for no reason. So for that, options are rarely exercised before expiration, and therefore, since they are rarely exercised, you should not worry about being assigned on an in-the-money short option before expiration in most cases. So check out that link in the description below where I have a full video explaining an in-depth example, and I go through all the numbers in great detail to explain why somebody would not want to exercise an in-the-money option before expiration if it has a lot of extrinsic value. All right, we're almost done. Let's go. Let's keep going. The last thing I want to talk about before actually getting onto the trading platform and doing these 4 basic options trades for you and showing you what they look like is to talk about a couple more specific things. First is, which stocks should you be trading when you're trading options? Well, not all stocks have options that you will want to trade. In fact, most stocks that have options you probably will not want to trade, or you'll want to trade them very carefully, because you only want to trade options that have deep option markets or have a lot of market participants and trading activity in them, because by doing so, you will make it a very fluid process when entering and exiting your option positions. If you trade options on a stock that does not have very much option activity, meaning maybe there's only 5 option contracts being traded a day, or there's very few open contracts or open interest, which we'll talk about in a second, in those option contracts, then you're effectively trading with nobody. That's kind of like going and finding a bunch of food on the street and you're trying to find someone to sell the food to you, but there's no market there, so you're just kind of standing there and there's no counterparty to your trades. So that's kind of a weird example, but it's a good analogy nonetheless. So when you are trading options, you want to stick to stocks that are very active. And typically, if you stick to stocks with high stock trading volume or stocks that people are trading very actively, if those stocks have options, most of the time those options will also be very active or liquid, as we say. Now, there's 2 things you can look at to see if an option market has a lot of liquidity or activity. The first is volume, which is option volume, and that is the number of contracts that have traded on a particular day. And every single expiration and every single option type and strike price will have its own volume, since those are all separate contracts. So you can look at the volume of option contracts on a stock, and typically you're going to want to see in the hundreds, if not thousands, of volume. But keep in mind that volume starts at 0 every single day. So if you're looking at volume early in the trading session, the volume could be low, even though the option markets could be very liquid and active. So the second thing you can look at is called open interest. Open interest is essentially the number of option contracts that are open between 2 parties. So if I buy a call option as an opening trade and another trader shorts that call option or sells me that call option as an opening trade, then open interest goes up by 1. So open interest tells you the number of open option contracts or existing positions in the market at a particular option type and strike price and expiration. So here's a list of just some example products with good or great option markets. So we have SPY, IWM, QQQ. These are ETFs. Then we have Apple, AMD, C, which is Citigroup, Intel, which is INTC. We have Tesla, Facebook, Netflix, and the VIX. These are all example products that have extremely active option markets and are very safe products to conduct options trades in. Because there's such large markets for it, there's a lot of market participants, which means the bid-ask spreads will be narrow, and therefore getting in and getting out of your trades will be much easier than compared to trading in options that don't have very active markets. So you need to be careful about which stocks you're trading, and you need to make sure that you have volume and open interest, but particularly open interest in the thousands, if not the high hundreds, close to 1,000, when you are trading options on these stocks. All right, so we've talked about enough theory. Now I'm going to actually hop over to my trading platform. I personally trade with tastyworks. I'm not going to tell you which brokerage firm you trade with, but to trade options, you will need to open up a brokerage account with a brokerage firm, and you will need, ideally, lots of option privileges to access the various strategies. So some brokerage firms have a tiered privilege structure, which means if you have tier 1, you only get access to basic option strategies that are very conservative. Tier 2 is slightly riskier or option spreads. And then tier 3 would be you have access to shorting stocks or shorting naked options, which is basically shorting call options, as we discussed earlier in this video, or shorting put options. So a lot of brokerage firms will have the tiered structure, but tastyworks, which is the one I trade with, they have an all-inclusive margin account, which is called the Works, and if you apply for that margin account and you open an account with them, you will have full privileges. So I'm not hard selling you here at all. I think it's phenomenal for everyone to do their own research and figure out which brokerage firm is best for them. But just as a fair disclosure policy, if you will, if you do decide to open an account with tastyworks and you enjoy my work and want to support me and the Project Option channel, if you use the Project Option referral code, you can get full access to one of the options trading courses that we have on the website that are not free, but you can get access to one of those courses completely free, no strings attached, for life, if you want to open an account with tastyworks and use the referral code. Now, I'm just telling you that because that's an offer that is outstanding and I want you to be aware of it should you go that route. But as I said, no hard sell here at all. I think everyone should do their own research and figure out which brokerage firm works best for them. But just in case you do go with tastyworks and I don't mention it here, and then a couple months down the line you see another one of my YouTube videos where I mention the offer and now you're all mad because I didn't mention it here and you wanted to use it, I'm just letting you know about that here. So I'm going to hop over to the tastyworks trading platform and we're going to look at real option prices, and everything is going to look similar to the images that you saw earlier because that was on the tastyworks trading platform. So I'm going to hop over to the platform and we will continue on from there, and I will trade each of the 4 basic option strategies that we discussed in this video, and I will enter the trades and then exit the trades and explain to you the profit or loss on those positions, which for the most part are probably going to be losses since I'll be getting in and out within a couple minutes, but we'll see how it goes. All right, the final stretch. So I've just opened up the tastyworks desktop trading platform, as that's what I use every single day. As I said, I think you should do your research, figure out which brokerage firm looks best to you and who you want an open account with if you don't have one already. But if you are a beginner, this could look pretty intimidating to you, and I will say that doesn't matter which brokerage firm you go with, there will be a learning curve, but all it takes is a couple weeks to get used to the platform and you are going to be smooth sailing. But really quickly, if you are unfamiliar, I just want to walk through a couple things with you. On the very left-hand side, this is just a watch list. So these are things that I have added to this list, and you'll probably recognize a lot of familiar symbols here, such as Apple, Netflix, Tesla, as we talked about earlier. And then I have some futures on here, and then the VIX index, which are different types of products. But the watch list is just there to keep an eye on different things that are going on in the market. and I can add or remove any symbols that I want to from that watch list, depending on what I want to be watching. So that's the watch list, plain and simple. The main panel here, which is where everything happens, is going to be dependent on which stock I have pulled up. So right now, we can see that it says IWM in this search box, and right here it says the Russell 2000 ETF, which is what IWM is. So if I change this, if I go to Apple, now it'll populate the platform with all Apple information, and we can see that the chart changed when I clicked on Apple. So I can change that back to IWM, and this is the chart page, simple enough. But I also have a couple other tabs here, such as the trade page, and this should look familiar to you because we spent a lot of time looking at this exact page in this video. And this is the option chain, so to speak. So these are all the different expiration cycles for IWM options, because we are looking at IWM, and that means that everything on the platform is going to populate for IWM. So these options are all IWM options. So these are the different expirations I can choose, and in the middle here we have the amount of days until expiration, as we have seen earlier in this video. But I want to talk about a couple things really quickly before we get to actually trading options. I want to talk about the bid and the ask price, and then I want to talk about volume and open interest, as I already kind of did before, but I just want to go a little bit more in depth. First, the bid and ask price. So every stock, every future, every ETF, every option has a bid and ask price. So the bid price is the highest price somebody is willing to pay to purchase something. So right here we can see that the bid price for a share of IWM is $134. This means that the highest price a trader in the world right now is willing to buy a share of IWM for is $134. And then we have the ask price. The ask price is the lowest price somebody is willing to sell something for. So right now the ask price says $134.07, and that means the lowest price somebody is willing to sell a share of IWM for is $134.07. And the difference between these two is called the bid-ask spread. So the difference between the bid price and the difference between the ask price is called the bid-ask spread. Now this is important because the wider a bid-ask spread is, the more money you will lose from simply entering and exiting that trade at the bid and the ask price. So if I were to buy a share of IWM, I would have to go to those people who are selling the shares, which means I have to go to the asking price. So if I want to buy a share of IWM right now, I have to pay $134.06. And then if I wanted to sell it immediately, I would have to go to those who are buying it, which means I have to go to the bidders or the bid price. So therefore, if I bought a share of IWM right now for $134.06 and then sold that share instantaneously, I'd have to go to the bid price of $134, and because of that, I would lose 6 cents for that transaction. So on just one share, I would lose 6 cents. It's the same for options, except since an option is worth 100 times more than the price, meaning that if I look at this 134 call option on IWM, the ask price says $564, which we know that is a premium of $564. So if I bought this option for $564 and immediately sold it at the bid price, which is a premium of $553, I would lose $11 just from entering and exiting the trade. Now keep in mind that the market is actually closed right now, and therefore these bid-ask spreads are going to be a little bit wider just because there's not actual trading going on right now. But when the market does open, I will be doing the actual trades for you guys, which will be buying calls, buying puts, shorting calls, and then shorting puts. But the first thing that we need to know is the bid and the ask price. So when I want to go to buy an option, I have to click on the ask price for that option. So if I just click on the ask price right now, we'll see that it highlights this 134 call option in the June expiration cycle. It says B1 right here, which means I'm trying to buy one contract. And then you'll also see that some information came down here. So if I just do that one more time, pay attention to the bottom of the screen. So I click on the ask price of the 134 call, and then it populates this information down here. And the price that we were looking at is the mid price. The mid price is the halfway point or the midpoint between the bid price and the ask price. So since the bid price right now is $553 and the ask price is $564, the midpoint between those two prices is $558. So typically when you're trading options, you're going to want to try and fill your trades, meaning actually execute the trades and buy or sell an option near the mid price. But in most cases, you might not get filled on your trade at the mid price right away, and therefore you might have to adjust your order price to a price that is slightly more unfavorable for you. So if you are buying something, a slightly more unfavorable price would mean that you'd have to pay a little bit more. So if I tried to buy this call for $558 and I didn't get filled, meaning that there was no other counterparty that wanted to sell the option for $558, I would have to increase my purchase price to $559 or $560. But the prices will be changing in real time, so it's a little bit more complicated than that, but that's the general idea. Now on the selling side, if I'm shorting something or selling something, I'll start at the mid price, and if I can't get filled, then I have to go to a slightly worse price for me. And when I'm selling something for a worse price means that I have to sell it for a slightly lower price than I did before. So the general process when trying to fill trades is start at the mid price, and then if you can't get filled, meaning you route the order but it's actually not filled, then you will have to adjust your order price to a slightly worse price for you. That price is going to depend on whether you're buying or selling. If you're selling, you have to decrease your price a little bit. If you're buying, you have to increase your price a little bit. And we'll see exactly how that works when we actually get to buying and shorting the options. Next up, I want to talk about volume and open interest. These are important to look at, especially if you are scouting out options on a stock that you've never traded options on before. You want to make sure that there is a option market or a deep option market on those options. And by deep option market, I just mean that there is a lot of trading activity in those options. So volume is the number of shares or contracts that have traded today. So there will be share volume, as we can see up here. IWM traded 32.6 million shares today, but we also have option volume. The option volume will be specific to the option type and the option strike price and in each expiration. So if we look at the 130 call option in the June expiration, we can see that the volume today was just over 1,000 contracts. But if I go to July and I look at the 130 call in July, that was 212 contracts today. So the 130 call is not a universal call option. It depends on the specific expiration date of the option. So typically the most amount of trading activity is going to be in what is called the front month expiration. And since the nearest term monthly expiration cycle is June, as we can see here, this is the most near term expiration cycle in the monthly expirations is June. This is called the front month. And the back month is July. So it's the one after the front month. Now there are option expirations every single month. The third Friday of each month there will be an expiration, and that is the standard monthly expiration cycle. And lastly, what I want to talk about is open interest. Open interest is different from volume in that open interest is the total number of open option contracts between two parties. And to simplify that, it's just the open number of option contracts. So right here on the 130 call option in the June expiration, we can see that the open interest says 47.8 thousand. Now this means that there are just under 48,000 130 call options that are currently open, meaning that there are a total of 48,000 contracts between people who own those calls and who are short those calls. So basically, between a person who is long the option, meaning they bought the option, and somebody who is short the option, the total number of contracts right now between all of those traders is 48,000. Now the reason open interest and volume are extremely important is because it'll make it much easier for you to enter and exit your trades. And with increased trading activity and a lot more market participants in the options and in the shares, the bid-ask spread will be narrower. So if we look at a stock that has a ton of option activity, meaning that there's a ton of volume and extremely high open interest and just a ton of trading activity in general, these options and the shares will have a narrower bid-ask spread compared to a stock that doesn't really have a lot of share volume and has very little option activity. So this is IWM, and the open interest in this case is incredibly high. As we can see, we have multiple strike prices that have over 50,000 contracts open in the open interest, meaning that there's a total of 50,000 contracts or more that are open between two parties, one being long, one being short. And on the put side, we can see that, again, there's many strike prices with open interest in the thousands. So generally speaking, open interest in the thousands is a good sign. But not every stock is going to have open interest with tens of thousands. That's really uncommon. It's typically in the most active products. So if we go to SPY, which is the S&P 500 ETF, we can see that, again, basically every strike price, look at this one, 183,000 contracts of the 300 call option in June. That's incredible. So all of these strike prices have open interest in the high thousands, multiple thousands. So if we go to a stock like the trade desk, we can see that the open interest is pretty thin. And by thin, I mean that there's not a lot of open interest, and therefore there's not a lot of volume. There's just not a lot of trading activity in these options. And if we look at the bid-ask spreads really quickly, we can see that the bid-ask spreads are fairly wide. And if we look at the 300 call option in the June expiration, the bid price is $23.20. The ask price is $2,500 or $25, sorry. And that means that there is a $1.80 difference between the bid and the ask. And when we multiply it by 100, that means that there is a $180 difference between the highest bid price and the lowest asking price. So basically, if I bought this option for the premium of $2,500 and I immediately wanted to sell it, I'd have to sell it at or near the bid, and that means I would sell it for about $2,320, meaning I would lose $180 just from buying and selling this option if I bought at the ask and sold at the bid. And if we compare that again, let's go to SPY just because it has the stock price near 300, which is similar to the trade desk. If we look at the 300 call, the asking price is $507 and the bid is $502. So there's only a 5-cent difference in the option price between the bid ask, and therefore the premium difference between the ask and the bid is $5. So if I bought at the ask of $507 and I sold the option at $502, I would lose $5 just from getting in and getting out. All right, so we are about to buy a call option, buy a put option, short a call option, and then short a put option. And I'm doing that so I can show you how to actually execute trades, how to get into the trades and exit the trades, and how easy that process is. And then I'll walk through some of these other positions that I have that actually have options that have seen big movements, because in the examples that we're going to go through where I actually buy and sell the calls, and the puts, they aren't going to move very much, and I'm going to probably lose a couple dollars on those trades, but I want to do it just because I want to show you how to actually execute a trade, meaning put on a trade. So the market's about to open in 10 seconds. I'm going to go to the AMD trade page. First thing we'll notice, volume for all the options is 0, but there's lots of open interest. So the market just opened, and now we can see that some volume is coming in for AMD options. So typically right when the market opens is not when you want to be trading. You don't want to route orders immediately when the market opens. You kind of want to let things settle down because the stock price could move overnight, and if it makes a big movement overnight, right when the market opens, those options are going to be somewhat untradeable, and I wouldn't recommend actually transacting in the options right when the market opens. So I'd give it a few minutes. I mean, right now we could go for it and start trading, but you don't want to be putting trades on or routing orders right when the bell hits. So now that the market is open, we can start doing some trades. So I'm going to make all the trades in AMD, and we're going to start with buying options. So I'm going to buy a call option and then buy a put option, and then on AMD I'm going to short options as well. So I'm just going to buy and sell the at the money strike. So right now AMD shares are at 54.85, and that means that the at the money option is the 55 strike. So I paused there because I wanted you to try to guess. So the at the money strike is the strike price near the stock price. So since AMD is right around 55, the at the money strike is 55. So as you can see here, 50,000 open interest in the 55 call expiring in June. A lot of volume, the most volume in this contract so far today. The bid price is $3 and the ask price is $3.10, so 10 cents wide. We're going to try to get filled in between these prices, so closer to the mid price of $3.05. Well, it's currently $3.05 right now, but it'll change. So to start, in order to buy a call option, I'm going to buy the 55 call. You click on the ask price, and that brings up an order to buy this option, and it automatically populates the price as the mid price. And this is a limit buy order if I just clicked it and said buy. So now these prices are changing, and this is changing as well because the bid and ask are changing. So let's see, $3 ask, $2.92 bid, $2.98 is the mid price. So I'm going to go ahead and click review and send, and it tells me my trade cost is a $298 debit. That's because if I try to buy an option for $2.98, we multiply that by 100 to get the premium of $298. So this is telling me I need $298 to purchase this call for $298. But then there's a $1 commission for entering the trade, and then 14 cents in fees. And when we close it, there won't be a commission. So on tastyworks, $1 to enter, free to close. So round trip, it's essentially 50 cents a contract. So let's see, the ask price is now $295, the bid is $286. So this option is falling. If I tried to buy this at $298 right now, since I'm buying above the market, so to speak, I would be filled instantly. So I don't want to do that. I want to edit the order, and I'm just going to route this really quickly at the current mid price of $291. So review and send order, and now it is a working order, meaning that it's sitting out there, but it has not yet been filled. So as soon as a counterparty can fill that trade at my price, it will be filled. But until then, it will be a working order. And I just click to the positions tab. As we can see under AMD, it says a working order to buy one of the 55 calls for a limit buy price of $291. And since the option is higher than that, I will not get filled. So a limit buy price, this is what you always want to use if you're buying options, means that you will not get filled unless you get filled at your price or better. So in this case, a better price would be $291, $290, $289, lower than my specified price. So by using a limit buy order, you can protect yourself from getting an unfavorable price. So you never want to use a market order, which means you'll get filled instantly but at the most unfavorable price for you. So this isn't getting filled. So I'm going to go back to the trade page. Actually, I can just right click on this, replace order, and then we can see that we have this thing down here that's telling me my current order price is below the market, so to speak, because I'm trying to buy at 291 and the mid price is now, well, there we go. So I got filled 291. So that is exactly how you fill a trade. You try to get filled at the mid price, you work the order, you let it sit there for a little bit, and if the market comes to your price and you're filled, then you're in the trade. So now we can see on the trade page, it says 1 around the ask price of the 55 call. So this platform is telling me that I have a position in this 55 call and I own 1 contract. So let's take a look at this on the positions tab. If I go to AMD, now it says my position in AMD is I own 1 June option with 28 days to go. The strike price is 55 and it is a call. My trade price, we can see right here, it says trade price. My trade price is 291. Ooh, and the option price has fallen to 274. So I'm currently down $17 on this trade. So let's go and buy a put. I'm going to buy the 55 put just like I did before. Now that the stock price is 54.35, this 55 put is in the money. So we can see 40,000 open interest. Not a lot of volume today, but that's okay. We'll deal with it. Open interest is the most important thing because this is just a general indication that there's a lot of activity in these options. So I'm not worried about it one bit. So to buy a 55 put, I click on the ask to begin this order process. So the ask is 340, the bid is 330. It brings up my order price at 335. And as you can see, max loss is 335. Buying power effect is essentially what my available amount of money I can allocate to trades will be reduced by $335 if I buy this option. So the mid price or the ask price is 345, bid price is 330. I'm going to review and send this at 335. And let's see what happens. See, right when I entered this order, the bid price changed to 335, which leads me to believe that my order changed the bid price. So now I am the highest price that someone is willing to buy the option for at 335. Now it's at 340, or actually I'm at 335, sorry. So it says working order on the positions tab. The mid price of this option is currently 345, and my limit buy price is 335. This is why I'm not filled yet. So I'm going to right click this, replace order, and now the market is higher than my price. So now the mid price is 342. So I'm going to go to 340, 345. Let's do 345 really quickly. So now it canceled my first order. And now I have a new order with a limit buy price of 345. So if I go to the positions tab yet again, I have a working order to buy the 55 put in June, 1 contract for a limit buy price of 345. And the mid price is currently 350. So this will have to come down just a little bit for me to get filled on this trade. Come on, give it to me. See, now it's increasing because AMD is falling. So AMD share price is falling. Remember, when we first bought that call option, AMD was closer to $55. Now it's at $53, $54. So it's fallen about $1. And that's why this put price is increasing and my call price is decreasing. So I'm going to go ahead and I'm chasing this, which is not good. You usually don't want to chase the order, but since I'm trying to do this and show you guys how it's done, I am wanting to get into this trade. So I just changed it to 355. Mid price is 357. So let's see if I get filled on this. 355 to 365. Mid price is 360. I'm still below that. Replace. I'm just doing this because I want to get filled on this so that we can move on. 360. Give it to me. There we go. All right, so I bought this 55 put for 360. And now I have an open position in the 55 call. and the 55 put. And I own these, and we know that because it's circling the ask price and it says 1. If I was short, it would say -1. So I now have a position in the 55 put and the 55 call in the June expiration cycle in AMD. So if I go to my positions tab, we can see that I have two options in AMD. My first is a call option that I purchased a little bit ago, and I paid $291 for it. It's currently at $258. So I'm down $33 on the call, and I just bought the put for $360. The current mid price is at $355. So it's telling me, well, now it's telling me my loss on this position is $13. So I'm going to close these now. And the way I can close them, well, actually, you can put on multiple positions at the same time. So I'm going to short options. I'm going to short the 60 call, and we do that by clicking on the bid. When you want to sell, you click on the bid to start the order process. So I'm going to click on the bid for the 60 call, and look at this, 877 contracts today in volume. So this is, look at this bid-ask spread. It's very narrow. So it's going to be very easy to execute this trade. Mid price is 95. I hit the bid, and that starts the order to sell it or short it. And we can see that it's red. It says S1. This means I'm trying to sell or short one of these options. Now the buying power effect actually says a credit. Usually, if I did not own this call option, I would need to put up a lot of money to short this call option. But since I own the 55 call, I don't actually add risk by shorting the 60 call, because if the stock price rockets higher, then my 55 call will always be worth more than my short 60 call. And since I own the 55 call, if I short the 60 call and the stock goes to $1 million, the difference between these strike prices is 5, which means this call will always be worth, if the stock went to $1 million, this call would be worth $5 more than the short 60. So there's no risk in adding this short call option. So the mid price is 94 cents. Review and send, and route it. And there we go. I just shorted the 60 call in AMD, and we can see that it circled the bid price this time, and it says -1. And that means that I shorted the 60 call option. Now I'm going to go to the 50 put, and I'm going to short the 50 put. Click on the bid, and that brings up the order to sell it. Mid price is 145. Again, it's telling me I have a credit because this actually reduces my overall risk in this position, because since I own the 55 put, if the stock went to 0 and I owned the 55 put and I was short the 50 put, the 55 put would be worth $55 if the stock price went to 0, and the 50 put would be worth $50. So this would always have, this 55 put would always be worth $5 more than this 50 put if the stock price went to 0. So there's no risk in shorting this option. But if I did not own these options, then shorting these options is incredibly risky, and I would need to put up a lot of buying power or margin to short those options. But since I own these options, shorting options at further out of the money strike prices does not increase my risk, and actually it reduces my risk, and that's why the platform is giving me a credit to my buying power equal to the amount of whatever I sell this for. So that's a little bit more complicated, but I just want to be thorough in the things I'm explaining. But I'm going to go ahead and short this 50 put now. The bid price is 144, ask is 147. So let's try to do it 143. That looks good. Send order. So I have a limit sell price at 143, and I just got filled at 143. So now I have a short position in the 50 put, a short position in the 60 call, and a long position, or I bought the 55 call and the 55 put. So if I go to my positions tab, we can check in and see how all of these 4 components are doing. Positions tab, go to AMD, and the 55 call I bought for $291. It's currently at $261. I'm down $30. 60 call, I bought it for 94 cents, or I shorted it for 94 cents, I'm sorry. It's at 91 cents. I have a $3 profit. The 55 put I purchased for $3.60 or $360. It's currently valued at $347. I have a $13 loss. The short 50 put, I shorted it for $143. It is worth $147, which means it has increased, and that since I shorted it or bet it against its price, an increase in its price means I am down money. So 143 to 148, that's a $5 loss. So now I'm going to go ahead and close these, and the way I could do that is I could right click and hit close position, which will automatically bring up an order for one of the components, but I'm going to do it manually. So since I shorted one of the 60 calls, to close it, I buy it back. So I click on the ask, and 92 cents looks good, send order. I'm trying to buy back the short 60 call. Let's go to the 50 short put. Since I shorted it and I have a short position, meaning I have -1 contracts, to close it, I buy it back. Click on the ask. 146 is the mid price. Review and send. Send order. There we go. So I got filled on the put. I bought back the put. So that I have no more position in the short 50 put. And we can see that there's no more box here, which means I have exited that position. Let's see what's going on with my short call. Positions tab. I have a limit sell price to sell this call to buy it back for 92 cents. Current price is 93. I'm going to drop this by 1 penny. I right click, replace order, drop it by, or actually, sorry, I have to increase it. So if I can't get filled trying to buy it back, I have to increase my purchase price. So now the bid is 93, ask is 94. I'm just going to go 94 to get out of this. There we go. So I closed the short 60 call, and now I have no more position in the short 60 call. So let's sell these options. I'm going to sell the 55 call by clicking on the bid, and since I own it, if I sell it, I will close the position. Mid price is 262, looks good. Review and send. Send order. Let's go to the put. 55 put, 345 bid, 350 ask. I own one of these, so to close it, I have to sell one. Click on the bid. Mid price, well, actually it's 350. Let's see. Mid price is 345. Review and send. Send order. There we go. I sold the 55 put. My 55 call, there we go. So I'm out. So what we have purchased a call option, purchased a put option, shorted a put option, shorted a call option, and then we closed all of those trades within a few minutes time. So just because an option has an expiration, it does not mean you have to hold until expiration. You can close the trade whenever you want. And I've just done that. So if we go back to my positions tab and go to AMD, we can see that it says zeros across the board. There's no more P&L information. It's because these positions are closed. So I can go to my activity tab and we can see everything that happened. So the 55 call, I purchased the 55 call for $291. I purchased the 55 put for $360. I shorted the 60 call for 94 cents. I shorted the 50 put for $1.43. And then I closed the 50 put for $1.46. So since I shorted the 50 put for $143 and I closed it for $146, I lost $3 on the short put. I bought back the short 60 call for 93 cents. And since I shorted it for 94 cents and bought it back for 93 cents, I made $1 on that trade, minus commissions and fees, which means I actually lost money. And then to close it all out, I sold the 55 put and I sold the 55 call. So initially I bought the 55 put for $360. I sold the 55 put for $345. I lost $15 on that. I bought the 55 call for $291. I sold it for $263. I lost money on that. So that's all well and good. I told you guys I was going to lose money, and that's what happens if you buy and sell within a few minutes time. You're going to lose money. Unless I had the opposite positions, I would have made a little bit of money, but at the end of the day, if you get in and you get out, you are going to lose money if you're just trying to get in and out in a few minutes time. So I would not recommend trying to time option prices on a minute by minute basis, because that is gambling. The shorter the time frame, the more options trading is like gambling. So now let's go to some other positions that have actually had sizable changes in the option prices. Let's go to NVDA. So I bought one of the September 2022 400 call options in NVIDIA that has 850 days to expiration. And I bought that call for $47.50, which if we multiply by 100, a entry price of $4,750. Currently the option is $80.72 or $8,072. So the profit on this is currently $3,300 in 16 days. That was 16 days ago. So this option has almost doubled in price because NVIDIA has been screaming higher, and I own this call option. So this is a big increase in the options price, and this is a little more exciting to look at because the AMD options only moved a couple pennies, and that's not too exciting. So when you're trading really short term, you're not going to have big changes in the option prices usually, unless you're trading earnings. But over longer periods of time, you can obviously have bigger changes in the option prices. Let's see what Facebook is. So Facebook, I have the 225-300 call spread. This is called a call debit spread or bull call spread. And I did this long term as well. This is in January 2022, I believe. And I bought the 225 call for $16.66. It's currently at $45.17. So there's a profit on that part of the trade of $28.51. But the second portion of that trade was shorting a 300 call for $4.72, and this essentially reduces the cost of buying the option. But since I shorted this 300 call for $4.72 and it is currently at $18.60, I have a loss of $1,388 on this option. So this is a spread, but as we can see, the 225 call, which has a lower strike price, has increased far more than the increase in the 300 call. So I'm still up money even though I have this portion of the trade that has lost money. Overall, the trade is positive. Let's look at something that's not profitable. Let's go to VXX. VXX, I bought 4 June 130 call options 2 months ago, and I paid $2.60 or $260 for 4 contracts, which is, let's see if I can do my math, $1,040. And now they're currently at 15 cents. So they're basically worthless. And this was more of a hedge, meaning I bought these to protect against further downside movements in the stock market. And more specifically, I bought these to basically make a lot of money on this part of the portfolio if we remained in a ultra high volatility environment. And since then, we have been rallying back. The volatility is much lower in the market right now. So VXX has gone down significantly. And because of that, these options are essentially worthless. But I'm not going to sell them because I've already lost pretty much everything I can lose. And they still have 28 days to go. So maybe if something crazy happens, they will protect the rest of the portfolio. But at this point, they're essentially doing nothing. They're worthless. But I'm not going to close them because I've already lost almost everything I can lose. So this is an example of a losing option. So I bought them for $2.60. They are trading for 15 cents. 4 times, that's a loss of $1,000. All right, we have made it to the end of this video, or basically the end. Congratulations to you if you made it this far. I know this video was extremely long, but as I mentioned earlier, I've been doing this for 7 years now, and my goal with this video was to package up everything that I would put into a beginner course and give it to you for free and in a few hours time. So I really hope you enjoyed all of the information I shared with you in this video, and that you have a pretty decent grasp on how options trading works at this point. Obviously, you should not expect to be fully comfortable with everything discussed in this video, as it's only been a couple hours, and I probably did 300 hours of reading and research before I even made my first options trade. So this hopefully is a great resource for you in getting to your 300 hours or whatever it is before you actually start placing actual trades. So if you made it this far, congratulations to you. I really appreciate you watching if you have made it this far, because this is my longest video ever for sure, and I basically put everything I had into this video, weeks planning the outline for the content that I wanted to discuss, and actually sitting down and recording it actually took 2 days. Somewhere in the middle of the video I stopped because my eyes were hurting. I don't know if you can see, I have this big light up here and it was just getting too much. So I actually recorded this over the span of 2 days. So I hope that you enjoyed everything that I shared in this video, and I don't know about you, but I need to celebrate. So I'm going to pop open some wine. I think you should get something too. Although if you're watching this in the morning, you probably shouldn't do this, and if you're not 21, then definitely don't do this. A toast to you for making it this far. Cheers. So where should you go from here in terms of learning? Because we've talked a lot about different things in this video, and I've explained to you some of the most important options trading concepts or ideas that you will have to encounter as a beginner options trader. But there are certainly way more things that you need to learn, because in this video we only talked about the basic building blocks of more complex option strategies. So we talked about buying calls and puts and shorting calls and puts, which will make up every single option strategy that you encounter in the future. So from here, I would recommend doing some research and learning about more complex option strategies, complex in their construction, but not complex in how they work or how they make or lose money. So my suggestion to you would be to start with the vertical spread strategies. So which would be buying call spreads, buying put spreads, and shorting call spreads and shorting put spreads. I would recommend these strategies because they operate in very much the same way as buying options or shorting options, but they have limited risk. So you will pay less when you buy a call spread or put spread as compared to just buying the call or put. And with shorting options, we talked about how much you can lose when you're shorting calls without any protection or shorting puts without any protection, but you can actually limit the risk of those strategies by shorting a call spread, which is shorting a call and then buying another call at a higher strike price to limit your risk. Or you could short a put spread, which would be shorting a put and then buying another put at a lower strike price. You also may have heard a strategy called an iron condor, which is essentially the combination of the two, where you make money if the stock price remains in a certain range. With that being said, I would really advise against shorting naked options. And these are going to be strategies such as just shorting the call, as we talked about earlier, shorting puts all by themselves, mostly shorting puts on leverage. You can short cash secured puts, meaning that you can actually buy 100 shares of stock at the strike price if you are assigned or you want to buy the shares. But also there's going to be more advanced strategies that are incredibly risky, which are the short straddle, which is when you short a call and short a put at the same strike price and in the same expiration. And then there's the strategy called a short strangle, which is shorting a call and shorting a put, and you make money if the stock price stays in the middle. But I would avoid those strategies because they do have immense loss potential, and all it takes is one trade to go against you for you to lose significant sums of money. And it is possible with these risky option strategies, it is possible to lose more money that you have in your account if something really crazy happens. And if you lose more money that you have in your brokerage account, you will have a negative margin account balance, and essentially that means you will literally have to pay back the brokerage firm. You will be in debt to the brokerage firm, and that is not a scenario that you want to be in. So my advice to you would be to learn the limited risk option strategies, which are the vertical spread strategies. I do have videos on those, but honestly, the videos I just watched the other day, they make me cringe because I was so bad. But I do have videos on vertical spreads if you want to watch them. They are good with the examples and everything. I just don't like how I recorded it. But then from there, I would learn about the option Greeks, which are measurements of expected option price changes given a change in the stock price, given the passage of time, and given a change in implied volatility. So the option Greeks will inform you of how your option strategy or your option position is exposed to these various effects or various factors that we discussed in this video that can influence an option's price and therefore influence your profit or loss on that position. I would also get started on your brokerage firm and get into the actual trading software that your brokerage firm provides, and I would track some options relative to changes in the stock price on a daily basis. This could be as simple as looking at Netflix and looking at some options that have 30 to 60 days to expiration, writing down the strike price, and then writing down the option prices and writing down the Netflix stock price as well. And then on the next day, as Netflix stock has changed, look at what happens to those option prices. So that is going to help you understand how the option prices will change relative to changes in the stock price and also the passage of time. So I would also write down how much time those options have until they expire. So all of these things, just observing is a very powerful learning tool in the options trading universe, because simply observing option prices through time as the stock price is changing, you can learn a lot about how option strategies perform and how the option prices will change in various stock price scenarios and through different stock price changes. I would also encourage you to look at an earnings announcement. So go and find a stock that is reporting earnings next, and ideally it would be a stock like Netflix or Amazon, something that is going to have a lot of hype around it and has good option markets. And I would look at the very short-term options right before earnings. Go and look at the stock price, record the stock price, record the option prices in the very near-term expiration cycle before the stock's earnings, and then look at it after earnings. See what happens to those options, particularly the extrinsic value in those options. And through that process, and through this whole general process of just observing, you will learn a great deal about how options work, and you will have much better expectations for how things will do or how your strategies will perform given various stock price movements. So that's going to do it, everybody. I really hope that you got a lot of value from this video. I certainly put a lot of effort into trying to go through the whole outline and explain things that could be confusing to you at the moment, and trying to explain things very intuitively, because unfortunately in the world of options trading, it is very confusing to learn because there's a lot of buzzwords and jargon that are thrown around. So in this video, I've tried to teach you a lot of those phrases and terms so that you understand what people are talking about when you hear other options traders talk. My name is Chris Butler from Project Option. I really hope you enjoyed this video. If you did, please give me a comment down below letting me know what you liked about it, if my pace was too fast or too slow, and just any general feedback, or if you just want to say thanks, I learned X from this video that I didn't learn from before. And if you have any questions, please leave a comment down below and I will get to you as soon as I can, or I hope I will get back to you as soon as I can, depending on how many comments there are. So thank you yet again for watching. I really hope you enjoyed this video. And once again, my name is Chris from Project Option, and I will see you next time.